Lots of uncertainty. It's the risk-off trade. No one wants to lever up.
Right now, it is business as usual, but maybe a little bit of a bird on the shoulder of uncertainty.
The volatility is not just in the equity market. Now it's cross-asset.
You're going to get an environment that is attractive for investment.
There are areas where you can look at the valuations and go, this is completely reasonable. But it is definitely more of a nimbleness, and you have to be watching things much more closely.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday on a two-day winning streak on the S&P 500 and looking to make it day three. On the S&P, we're positive by 0.1%. On the Nasdaq 100, we're up by a similar amount. On the Russell 2000, up by 0.25%. Your day ahead looks like this, a focus on both the data and the earnings as well. At 8:30 Eastern Time, we get jobless claims. Then later on, after the closing bell, we hear from Amazon. Amazon earnings coming up after the close. Before we get there, music to Bramo's ears from the Treasury Secretary, Scott Bessent, that me and the President of the United States are focused on, guess what? The 10-year Treasury yield.
I told you this is going to be the most important thing of this entire year. And look at that. Scott Bessent, you heard me. I'm with you. I think we all agree that is going to be the most important metric. The interesting aspect is it takes the pressure off the Fed to cut rates in the near term. He did, of course, go after the Fed on some level, saying, well, they were the ones that messed up in the first place by cutting 50 basis points, and that led the 10-year to rise. But it highlights how they are concerned about inflation and they're concerned about borrowing costs and how that's going to inform their decisions more than any kind of political interference.
This is an argument we've heard before. We've heard it before on Wall Street, that the reduction of interest rates from September through to the end of the year, 100 basis points, actually contributed to the high yields at the back end because there was a worry, a concern that maybe the Fed would be allowing this economy to run a little bit too hot.
He leaned into that idea. At the same time, on the flip side, how much does this affect his decision or not to lengthen the duration of some of the deficit, given the fact that we had the announcement yesterday of the Treasury refunding, and it didn't include lengthening the duration like Scott Bessent said that he previously would? How much is that going to be a limiting feature to some of their plans, just simply because they are very cognizant of what we all are, which is auctions and the 10-year Treasury yield?
So two-part story to that. How are they going to manage the average maturity over at the Treasury? One. The second point, I think, is an important one. Will they be constrained by this bond market as they start to develop just how big they want these tax cut plans to be?
Well, that's the problem. Trump 2.0, everyone is saying, is going to mean higher yields because you have a ballooning reconciliation bill. Potentially, we're waiting on whether that's going to be one path or two. And also, on top of that, the fact that whether or not it's pervasive or one-time hit, many economists will tell you tariffs are inflationary.
When you step back, it puts these two ideas against each other. The idea of more nationalist putting tariffs on types of policies that typically aren't as good for growth with the pro-growth aspects. And you think about the 10-year Treasury yield, and if that is their metric, do they like the fact that tariffs are being treated as maybe disinflationary? And down the line might be a damper on growth, even the uncertainty. At what point is the damper on growth a problem, even though you're getting the lower yields on the long end that some of these officials want?
I think we've all got some follow-up questions. The good news, you get round two of Scott Bessent a little bit later on, right here on Bloomberg TV and on Bloomberg Radio, sitting down with our print reporter, Sonia Meskin. Look out for that later on this afternoon. That is going to be must-watch. Equity futures right now on the S&P 500, just about positive. The hour ahead looks like this on Bloomberg Surveillance. We'll catch up with Anwiti, Bahuguna of Northern Trust with stocks on a two-day winning streak. Ed Mills of Raymond James with Bessent focused on 10-year Treasury yields, and Scott Devitt of Wedbush previewing earnings from Amazon. We begin this hour with stocks looking for a third straight day of gains as traders look ahead to a busy stretch of earnings. And Anwiti Bahuguna of Northern Trust expecting volatility ahead, writing political uncertainty is likely to remain high during the first few months of the new administration. We think investors should maintain a flexible investment strategy that can adapt to changing trade policies. And Anwiti joins us now for more. And Anwiti, good morning. Based on that, you've been busy. How busy have you been?
It's been a little hectic, yes.
Have you had to become super tactical?
Actually, quite the reverse, John. We really, over the weekend, published our capital market assumptions, which focuses on our 10-year outlook for asset classes. And, situation for equities looked decent. It's quite contrast then that Sunday night we were focused so much on what it means for the next day while we are publishing our 10-year view. And yeah, we have to be super vigilant to what's happening every other day now in terms of are we on or are we not. And any kind of positioning you have, one morning you look great because you were defensing on Sunday night, and then in the afternoon of the day when those tariff issues are no longer relevant, then your positioning
and
looks
it could
weak.
change again in 5 minutes' time. I'm just picking up on the line that you wrote. We think investors should maintain a flexible investment strategy that can adapt to changing trade policies. What does that mean?
Yes. So what that means is that in the near term, so 3 to 6 months, while all these negotiations are underway, we expect volatility to be high. But if you look at the fundamentals of the economy, we're expecting pretty decent economic growth this year, around 2.5% or so. Inflation is the big question mark. And keep focusing on that. And company earnings first quarter so far coming out quite fantastic, really, I would say 9 to 10%. And for the full year, expected to be even more than that. So keep focusing on that. The rest is noise. We won't have clarity on that for a while. That clarity may appear sometime in the middle of the year. And if at that point we know what that looks like, because there are several outcome nodes for all these policies, then reassess, be flexible. Flexible also when the market overreacts to some of the near-term noise. Reposition yourself if there are opportunities at that time.
I love this. People talk about what's going on in Washington, D.C. Noise. It's just really confusing right now. Black box. How can we say anything? It's basically how many times can we say? How many different ways can we say? We have no clue. Don't make us comment on it. I am wondering about the uncertainty that we're seeing, even in the narrative around earnings, though. We saw some of the CapEx plans, in particular from Alphabet, and they were punished, even though it was a capacity issue that constrained their sales of some of their cloud computing offerings. I'm just wondering whether this narrative in the market of shifting away from some of the big tech drivers and the CapEx that really went into cloud computing and some of the AI adoption and the broadening out, whether you believe in that narrative having staying power or whether you think that the flipping and the flopping of that is noise.
Yeah, that's a great point, Lisa. We believe in the broadening of earnings this year. And we saw some of that actually in third quarter of last year also. But if you look back for the full year, it was still an AI concentration in tech, that kind of market behavior where everything else was participating, but not to quite the extent that the tech sector was. This year is likely to be noisy, likely to be volatile. Even before the tariff news, there was question mark around, the deep seek news. Our contention is, aside from flexibility, which Jonathan mentioned, another thing to do in the portfolios is to be diversified, to go away from just the tech-focused names and focus on companies with really great balance sheets, with good earnings potential, companies that have so far been sort of ignored by the market, but are really solid companies, such as companies which have quantitatively a low volatility score and a quality score.
Is it still the U.S. that's the focus, or does diversification increasingly mean outside of the U.S. at a time where we heard that in January, everyone was saying, all right, let's think about how low the bar is in Europe, and then Europe gained 8%, and then people are saying, wait a second, maybe let's come back here because tariffs are going back on. I mean, how much do you lean into the ex-U.S. story?
We're still saying Buy America. Even our 10-year outlook has a higher number for U.S. returns than international developed, mainly because of the structure of the earnings component in all these economies. The earnings story for U.S. remains very strong. The buyback story remains very strong. And there are these structural issues in the rest of the world where, as opposed to the buyback story that we see in the U.S., we actually see dilution elsewhere in the markets. And that keeps us U.S. focused.
When it comes to the U.S., though, right now, all the bad news is being priced in, or the uncertainty about tariffs, and some of the good news when it comes to the tax cuts. But we don't have tax cuts just yet, but we do have an extra 10% put on Chinese goods. If you get no tax cuts at the end of the year, do you still want to be invested solely in the United States?
Absolutely. I think the consumer is super strong. The companies are doing very well. So the tax cut is not the only driver. It's not even cut, Annmarie. It's the fact that they won't go up. that still remains the driving factor in the market, that we're not really waiting for additional cuts, but the threat of increased corporate taxes is off the table.
We've had some heat come out of the US story over the past few days. You saw that in the ISM services yesterday. Prices paid a little bit lower. The overall headline read came in a little bit lower. We saw it with job openings as well, falling back just a little bit. Nothing to get too concerned about here. I'm not going to say that the Federal Reserve needs to come out and cut interest rates before the next meeting. There's nothing bad out there at the moment. But to Anwiti's point, there's nothing out there to suggest at the moment, based on the data that we've seen more recently, that they need to hike anytime soon.
Which is the reason why you saw a huge rally into duration yesterday, and why you are seeing that rally in the bond market globally that's really feeding into that broadening out story and this idea that this is a positive disinflation, not necessarily something that's coming with cratering growth.
Speaking of the global story, did you see the headline coming from McKinsey?
Yes,
Being global is a choice. Frankly, it is more difficult now to make that choice. I know this is difficult and may become increasingly so. Speaking directly about China.
Maybe they are going to pull out of China. This is what we were talking about yesterday. How long before companies start signaling that the uncertainty is just too difficult? And frankly, it was a money-losing business for them, right? So it's not like they have that much on the line. But the head of McKinsey has wanted to be a global company. Is the idea of being a global company losing some of its flair because of some of the liabilities associated with being with places where the policies are changing so quickly?
The question is it worth the risk? And right now, you have to look at the long term. Is it worth the risk being in China? Jameson Greer will have his hearing today. And last time we heard from him on Capitol Hill, he talked about decoupling the United States from China.
This, by the way, works both ways. If you're Shein and Temu, you're probably thinking the same thing about having a presence in the United States at the moment, based on the headlines we've seen over the past few days. Plenty more still to come on the programme on the tension between the United States and China and what it means ultimately for your investments. Right now, equity futures just about positive by 0.1% on the S&P. With an update on stories elsewhere, let's cross over to Yahara Hekes for more. Hey, Yahara.
Hi, John. U.S. Treasury Secretary Scott Bessent says in order to lower borrowing costs, the administration's focus is on bringing down 10-year Treasury yields, not the Fed's benchmark rate. In an interview last night, Bessent said Trump is not calling for the Fed to lower rates. Bloomberg's Sonia Meskin will have an interview with Secretary Bessent today at 1 p.m. Eastern. Google is the latest company announcing changes to its diversity hiring plans. According to an internal memo, it said it's reviewing its programs and would no longer have, quote, aspirational goals tied to representation. It joins Meta and Amazon in big tech's retreat from DEI initiatives, which have been rejected by President Trump's administration. Tesla sales in Germany plummeted 59% last month. Only 1,277 new cars were registered. It hasn't seen those levels since July 2021. Musk's intervention in Germany's upcoming election was likely a factor, with a poll taken last month showing he was viewed unfavorably and his political interventions were unwelcome. That's your Bloomberg Brief. John?
Yahara, thank you. We'll see more from Yahara in about 30 minutes' time. A special thank you, of course, to Anwiti Bahuguna of Northern Trust as well. Anwiti, thank you. Up next on the programme, Trump focused on bond yields and not the Fed.
He wants lower rates. He is not calling for the Fed to lower rates. He and I are focused on the 10-year Treasury and what is the yield of that.
Ed Mills of Raymond James joins us next on the programme, live from New York City this morning. Good morning. Bond yields a little bit higher right now by 2 basis points on a 10-year, 4.44. The next stop for this market, jobless claims later on this morning. The estimate in our survey, 213. The previous week, 207. The number drops at 8:30 Eastern Time. Under surveillance this morning, Trump is focused on bond yields and not the Fed.
He wants lower rates. He is not calling for the Fed to lower rates. If we get this tax bill done, if we get energy down, then rates will take care of themselves and the dollar will take care of itself. He and I are focused on the 10-year Treasury and what is the yield of that. I believe the bond market is recognizing that, as you and I talked about, energy prices will be lower and we can have non-inflationary growth
So here's the latest this morning. Treasury Secretary Scott Bessent making clear that President Trump will not pressure the Federal Reserve to lower interest rates, saying the administration's focus instead is on bringing down the 10-year Treasury yield. Joining us now is Ed Mills of Raymond James. Now, Ed, welcome to the programme. I wonder what consequences this might have, if any, for the tax cut talks over the next few months.
Yeah, John, there's a lot to talk about here because, the first thought I have is as soon as the Treasury Secretary says Donald Trump is not focused on the Fed lowering rates, we're almost near guaranteed getting a headline from Donald Trump saying the Fed needs to lower the front end of the rates. I do think that when I hear these comments, it is going to be difficult to do as much of the tax cuts as Republicans want to do. Another thing in that interview, Treasury Secretary Bessent said that they should do a score that would allow Republicans to make the tax cuts permanent, extending out current baseline. If we are going to see a $4-5 trillion plus increase in the debt and the deficit over the next 10 years, that's more than what the bond market's been looking for. And finally, I guess the thing I would highlight here is that in Trump 1.0, everyone was focused on the equity market, and that was the barometer of Trump's success. Increasingly, clients at Raymond James have been asking me, is the bond market the new barometer? And last night, Treasury Secretary Bessent kind of made that official that we're going to be watching the 10-year to see how successful Trump policies are going to be.
And Ed, isn't that because the bond market has a seat at the table when it comes to what you're discussing, this huge tax bill and whether or not they can go as far as they'd like to go?
Yeah, and when I've talked to folks in and around kind of the Trump administration, one of the things that they want to highlight is tax cuts are only one part of the story. They want to talk about the deregulatory agenda. They want to talk about DOGE. They want to talk about the amount of money that's going to be collected, Annmarie, from all of the tariffs that are going into place. And so if you want to get what the Treasury Secretary is describing, I think the market has to be prepared that there's going to be other sources of tax revenue that's coming in and other cuts to the federal government spending. And so the aggressiveness that we are seeing right now by Elon Musk and DOGE is part and parcel giving political cover for the Hill to go a little bit further or a lot further than they thought they might be able to do.
Well, let's discuss how they're going to do that. Senators will sit down with Trump this weekend, and they're talking about this two-path bill. I caught up with Congressman Jason Smith yesterday, who still wants this one big, beautiful bill. But, Ed, that seems to be collapsing in real time. What's your take on the next steps for the Republicans in Congress?
Well, next steps, Annmarie, is getting a budget. You can't start the budget reconciliation process. You have nothing to reconcile until you pass the budget. And so this is where the fact that Republicans have as slim as possible of a majority. You lose one vote, you can't get this done. So Donald Trump is also going to be having a conversation later today with House Republicans. He's going to see if he can get them to pass something to start the process. They're still fighting over process. Until you figure out the process, you can't get a bill. I absolutely still think we're going to get the tax bill done. It could be permanent. They could add tax cuts to this if they use the score that they're talking about. But until there is leadership from the White House to instruct them on what to do, we don't know what we get from the Hill until that point.
Ed, I loved how he started this conversation about how important the 10-year is and how this might be the ultimate check on the market. I thought that the photograph that we showed really set it up perfectly, where you have Donald Trump in the middle and you have Scott Bessent on one side, bond representative, and then you have Howard Lutnick on the other side, who in some ways is stock representative, growth representative, trying to get some of these other things across. Who has the louder voice, the louder influence over the man in the middle, Donald Trump, at a time where there are a lot of competing egos, a lot of competing wishes, and it's not clear just how constrained some of those people are going to be by, say, the 10-year yield?
Yeah, Lisa, I guess my flippant answer to that would be the last person who spoke to him. That's what we have seen countless times in this. He has once again instilled what we'd call a team of rivals. And we've seen this in elsewhere, too, on trade, on tariffs. There is a huge match between Team Econ, which is Scott Bessent's world, versus Team Tariff. That is Lutnick. That's going to be Jamison Greer, as mentioned. He's having his hearing today for U.S. Trade Representative. That's Peter Navarro. So what I've been instructed to do when I'm listening to all these competing voices is find areas of commonality. and that's going to be the likely policy. And one of the things that I think the market has been missing is the most dovish view coming out of that kind of team of rivals on tariffs is only starting at 2.5% of a universal tariff and getting to somewhere to 10 to 20%. If that's the dovish view, I want to know what the hawkish view is.
At that point, Ed, how do you advise clients? How do you advise companies that want to make plans, want to understand what their footprint should look like, want to understand where they can expand in the world? Are you telling them to just hold off and that, frankly, they will not know just what that hawkish view is and how high it could go?
Yeah, I'm not telling them to hold off, but I am telling them to expect volatility. I was at a conference yesterday down at our headquarters in St. Pete at Raymond James talking about how volatility is back and that you have to kind of not react to everything to get some of the big conversation right. And so there are a number of things out of this administration that could be viewed as market positive. There are other things that could be viewed as market negative. The way in which they implement that, the timing and the degree, all are going to be the big conversations of 2025, but don't stay paralyzed because if we stay paralyzed, you miss out on a lot of opportunity. Been doing this job for a while. I can always tell you the risk, but that has not been the right strategy before, and I don't think it's the right strategy now, Lisa.
Sequencing matters, Ed. I think we've all been saying that over the last several months. We wanted to know what would come first. We found out the focus was on trade and pretty quickly. For this market at the moment, I wonder how quickly things could change again when we really start to see what's going to happen with the tax package. When do we start to get a better idea of the contours of that? Is it going to take weeks, months? How long?
I think we'll get some idea within the next couple of weeks. As I mentioned, you have to pass the budget first. And Republicans, if we can get a budget in the February, March time period, people will get optimistic on what can get done. And then I want to see what score they're using. It's a technical thing, but if they use a score that says extend out current policy, which is what the Treasury Secretary is expecting to say, that's where we have the conversation about these tax cuts being permanent. That's not priced into the market. If we are in March and April talking about permanent tax cuts as a high probability event, that's a market positive from where I sit. It might have an impact on the 10-year that the Treasury Secretary does not want, and that might be the binding constraint. But I do expect that we will have moments of clarity followed by everything falling apart before it ultimately gets done. And one thing I say about D.C. is that things appear impossible right up until the moment they're inevitable. But I do think it is inevitable this year we will get something done on tax cuts.
Ed, this was brilliant. Looking forward to being on the journey with you. Ed Mills there of Raymond James on a path forward for the year ahead and the next 4 years. I remember a quote that came from Marko Klanovic, formerly of JPMorgan, who made the case that the biggest challenge for the incoming Treasury Secretary, now Secretary Scott Bessent, wouldn't be enacting change. It would be managing the volatility and the market reaction that might undermine those changes. So when we think about Treasury, you said this yesterday, the complaints about what Treasury Secretary Janet Yellen did with the activist Treasury issuance at the front end of the curve, Rabini's and Miran's words, not my own. And then what do we see from them? A reluctance to term out the debt. And based on those comments that we heard from Scott Bessent, I'd love to know if there's still that reluctance to term out the debt or whether those complaints stick. Those complaints to Secretary Yellen, do they hold and do they want to make a change?
Clearly, they didn't want to make a change that quickly. So clearly, the actions speak louder than the words. The words, we're already getting some sense of what the words will be like. We have to study it. We want to make sure we do it in a prudent way. We want to have a time. We're just in the door. We've only had 19 days. Come on. Why are you pushing us? The reality is, it clearly is their focus, and that definitely is going to be a constraining factor.
If you want lower 10-year yields, terming out the debt probably won't help. Pushing out the supply further along the curve, just logically, probably won't help.
Which is the reason why I am skeptical of that happening in the near term. However, if inflation comes down and there is some sort of disinflationary shock, and maybe that's the sort of bad angel that comes out and is like, we're putting on 40% tariffs. If you get a tanking 10-year, maybe they term out the debt in that moment.
Up next on the programme, we'll count you down to the earnings later on after the closing bell. Scott Devitt of Wedbush looking ahead to numbers from Amazon. That comes a little bit later. If you're just joining us, welcome to the programme. Equity futures on the S&P just about positive by 0.1% in the bond market. Bond yields higher. Good morning, Mr. President. The 10-year, 444. Bramo, it's your world.
I feel so seen.
They're coming around, aren't they?
Yeah, absolutely.
This is Bloomberg. Equities on the S&P 500 just about positive by 0.05%. Looking for a 3-day winning streak on the S&P. On the Nasdaq right now, negative by 0.1%. Shook off some of the tech jitters in yesterday's session more broadly. Not a great day for the likes of Alphabet through most of yesterday's session. But for Amazon's up next after the closing bell. Look out for cloud revenue. We'll talk about that a little bit more in just a moment. Turning to the bond market, 2-year, 10-year and 30-year. The big takeaway of the data of the past few weeks, taking out just a little bit of heat from the economic story in America. Things still okay, but just not as hot based on the ISM that we saw yesterday and the job openings number we saw before that. Bond yields a little bit higher here, Bramo, by 2 basis points. The 10-year, 443.62.
I have to give you a victory lap. Yesterday, you said to me the most important data point of the day. You said not ADP, and you were right. You said it was going to be ISM services, and indeed, it was ISM services, but it wasn't necessarily even the headline number that came in softer. It was the fact that prices paid, that component came in weaker, softer than people expected. It all speaks to the idea that inflation, it's not going to happen. And increasingly, you've taken the risk of a possible rate hike off the table and really increased the risk of possible rate cuts.
I'll take credit when I deserve it. I'm not sure that comment deserved that much credit.
You get full credit.
I don't think it required that much foresight.
It was.
The ISM might be more important than ADP, but
I think
I'll run with it. You're being kind. I like
it.
Okay. I'll accept the compliment. Thank you. Let's turn to foreign exchange. I want to focus on sterling. 30 minutes away, there's a Bank of England rate decision. And Governor Bailey might have to do something that no central banker wants to do anywhere on the planet. Downgrade the outlook for growth and upgrade the outlook for inflation. That ain't good. Sterling's down to 124.27.
The interesting thing is, 3 weeks ago, when you saw the highest 10-year gilt yields going back to 1998, people were speculating that they wouldn't have the room to still cut rates with that type of outlook, with a higher inflation outlook and a lower growth outlook. Now everyone is expecting them to still cut rates. And who gave them the pass? Perhaps the ISM services data that showed prices paid came in lower. There is a feeling that maybe we're not on this inflationary spiral that gives them the space to cut rates, but it highlights how constrained that central bank is in a way that maybe the Federal Reserve isn't.
Gilt yields lower, sterling a bit weaker, cable 124.27. Let's get you some news on our radar this morning. Treasury Secretary Scott Bessent saying the Trump administration is focused on bringing down 10-year bond yields, adding that the president is, quote, not calling for the Fed to lower rates.
So this is a change of tune from the president. I would say the president did say on Sunday to reporters that the Fed did the right thing. But how many times have we seen Trump 1.0 campaign trail coming into the White House? The president constantly saying he wants lower interest rates. He is a real estate guy, and he thinks he knows better than Jay Powell. So I'm just kind of wondering how long will this reversal in terms of where they are happy with where interest rates are is going to last.
At the same time, Tom Barkin, who was here yesterday, came in and he said, people think we control mortgages. People come up to me and they're saying, it's so expensive to buy a home. What are you going to do about it? And he said, we don't control that. We control the front end at best. So this is a real estate developer who is listening to people who understand that actually maybe the Fed doesn't hold the keys to the rate that he actually cares about. So, maybe this will stick. We'll see.
I'm a real estate guy. They dropped rates and mortgage rates went up. But this is what Bessent's getting at, right? Secretary Bessent is making the argument that reduction in interest rates contributed to those high yields at the long end, contributed to higher mortgage rates, which for people listening who might not be on Wall Street might sound really counterintuitive, but that's the argument that some people have made.
If you lower rates in the near term and people believe that there still is quite a bit of heat in the economy, then they ratchet up their expectations of long-term growth and inflation. This is the delicate balancing act that Scott Bessent, with a real estate developer as president, needs to manage. And it's the reason why maybe we saw the president come out and say he actually thinks the Fed did the right thing by holding, which surprised everybody.
How difficult is this going to be, though? Because, of course, tax cuts, higher tax cuts, and when Ed Mills was talking about what Scott Bessent said yesterday to Larry Kudlow, that he wants them to be permanent, how much more are you going to have to tap the debt market for that? And how much more is the bond market just going to push back on a higher U.S. deficit?
The 10-year Treasury yields right now higher by 2 basis points, 4.44. Let's turn to another story. U.S. allies expecting President Trump to present a plan to end Russia's war on Ukraine next week. Sources telling us here at Bloomberg the plan potentially includes freezing the conflict and providing Ukraine with security guarantees.
So I would say, and I was part of this reporting with the team, what I would say is this month is going to be pretty critical, and you can already see a major shift in tone. President Zelensky sitting down for an interview this week saying that he wants to end the, quote, hot stage of the war, and he's willing to speak to Putin. Now, after General Kellogg goes to the Munich Security Conference and unveils this plan to allies, he's also going to be, it's his first time as this envoy, going to Ukraine. At the same time, Zelensky himself is also going to to be making a trip to the Gulf, definitely going to Qatar, definitely going to the United Arab Emirates. Diplomacy in the works at the moment because Trump is really forcing their hand to get to the negotiating table.
They are going after so many things simultaneously, it's almost jarring because it was so sleepy in the final few months, the final few years of the Biden administration. The contrast is just absolutely stark. How much they're getting done and how quickly it's happening, whether you like it or not, over the past few weeks.
Everything, everywhere, all at once. They're firing on all cylinders. And I've spoke to sources yesterday. I was at the White House. Everything they talked about and were preparing after Trump won the election, they wanted to come in and they wanted to make sure all of their people were in place, at least the initial top-level people, to get these things done. It is jarring because, not to be rude, but Biden was like watching paint dry. He himself would drag his feet for every decision, where Trump just comes out, and even if something is an idea floating around the West Wing, he says it out loud.
That's the latest on that front. Let's turn to the earnings. Ford warning the profit may fall by $2 billion or more this year, citing lower vehicle prices and expenses linked to the launch of new models. The company saying the forecast does not factor in potential tariffs from the Trump administration. That name is down by more than 6%. And Bramo, it could get a lot worse if we do see those kind of tariffs.
Well, Ford itself said that they could see billions and billions in profit destruction should some of these tariffs go into effect. You can feel this delicate dance that a lot of executives are doing. On one hand, they want to warn about the consequences of some of these tariffs, but they don't want to get in the bad graces of the president. So there is that sort of olive branch saying, we know that he doesn't want to destroy Detroit. We know he wants a strong, robust U.S. auto manufacturing sector. You can feel this tension as they realize just how much carnage could be done to their business and their profitability.
Ford is down this morning in the pre-market by more than 6%. Let's turn to more earnings. Let's turn to tech. Amazon reporting earnings after the closing bout today. Scott Devitt of Wedbush rating the stock outperform with a 280 price target, expecting another year of gains for the company. Scott joins us now for more. Scott, welcome to the program. We've heard from Google, we've heard from Microsoft. What do those two names tell you about what we could hear from Amazon later?
Well, I think the biggest overlap comes in the web services business, where Microsoft and Alphabet both underperformed. There's some idiosyncratic effects, particularly as it relates to Alphabet. The company didn't have capacity in the cloud business, which was the reason that it missed by 200 basis points. Microsoft was a little bit of a different story. So it'll be interesting to see whether Amazon, kind of takes control of the narrative again in web services in terms of being a share gainer, and that they're AI positive relative to kind of the positioning it's had the last 12 to 18 months of being, an AI market share donator to Azure. So that to me is the biggest data point, from those two. Otherwise, Alphabet and the advertising business was quite strong. I think that's a positive data point for Amazon's retail business as well.
At the same time, Scott, there's been a vibe shift in a pretty big way when it comes to capital expenditures tied to cloud computing and just how some of these companies are going to expand. We saw that Google was penalized pretty significantly by their $75 billion price point for how much they plan to spend. Do you think that Amazon can shift the narrative on capital expenditures at a time where really it's the fact that supply cannot keep up with demand?
Well, Meta, the stock responded positively to high levels of CapEx because the market's viewing Meta as being front-footed, and Alphabet, as being, on its back foot and having to spend to keep up in this transition, and so effectively diluting the margin profile. I think Amazon sits somewhere in between. I mean, there's a necessity to invest in the cloud business to retrofit it for selling AI services, but a lot of the Amazon spend as well goes to fulfillment centers and other things which are driving incremental high levels of growth. And so I think the market response, to the extent that Amazon doesn't shock with CapEx, but instead of, say, our $87 billion estimate, it comes in somewhere 90 to 95, that'll be digested quite well so long as the fundamentals are as strong as we think they are.
Scott, the focus has been so much on spending by some of these big tech guys. How much is the focus going to shift to cost cutting, to efficiencies? Andy Jassy has come out and talked about cutting middle management in particular and replacing with some of these machine learning tools, potentially to reduce costs. How much are you looking for that type of announcement today?
So we had, 22, really the year of discipline across the board for all these companies coming out of the pandemic. And then, you've gone back into investment mode, but it's non-human capital investment. And I think you'll continue to hear that from companies, including Amazon, becoming more efficient with human capital, and those gains being redeployed into capital infrastructure. And so I don't expect, meaningful leverage from Amazon in terms of that transition. But what I will say with Amazon is they're benefiting from a shift in their business in terms of where the advertising business and the web services business is so big now and growing so much faster than the retail business that they have a natural lift to their operating profits over time. And so Amazon, over the next 5 years, we expect that their operating profits are going to grow on a CAGR basis north of 20%, which is well north of both Meta and Alphabet.
Scott, Morgan Stanley says that Amazon's exposure to tariffs is higher than other e-commerce companies. What are you expecting on that front when it comes to the trade war we already see take place between China and the United States?
I try to take a wait and see with tariffs. I mean, if someone can explain to me what they're going to be and where they're going to be and everything else, then maybe we can put them in a model. But I think that Amazon is as well positioned, probably better positioned than anyone to deal with it. Certainly merchants that access inventory from places like China, could be affected. But I do think that, without having all the information, it's very hard to answer. But I do think that if it's a net negative for retail overall, then that's a negative for Amazon. But they're going to weather the storm better than almost any retailer, if not all.
Well, in this note, Morgan Stanley talked about that roughly 25% of the cost of products directly sold by Amazon come from China, and those items account for a little less than half of all products sold on Amazon. What's the wait and see? 10% was added to already the tariffs that existed on China.
You would either be digested by consumers, which is a possibility. We don't know what the outcome is going to be in terms of negotiations with China. And you also have the possibility of resourcing products from other locations. And I think nobody's more nimble than Amazon in terms of being able to help merchants do that. So like I said, I think it's a difficult question to answer at this point in time. And I would argue strongly that if you look at their peers in terms of the larger retailers, there's a lot of sourcing from China as well. And Amazon's very well positioned to defend against the change in terms of the cost structure of its merchants.
Hey, Scott, appreciate the input this morning. Thank you, sir. Scott Devitt there of Wedbush, looking ahead to Amazon earnings after the closing bell. Three-part story there for many of you I know. The cloud business, what happens with ad spend, and ultimately what happens with e-commerce. On the cloud business, things were pretty mixed over at Google and Microsoft. Not impressive. That held back those two names, particularly for the likes of Alphabet. On the trade story for e-commerce, I think that's one to watch a little bit later. Is this helping them or hurting them, given what's happening to Temu and Shein?
That's a great question. How much are they able to redirect or capture a greater part of the business? We saw that Shein was being charged some 30% increases to ship into the U.S., and they were worried about logistical delays because no one knows how to process some of these tariffs. So if there is this lack of knowledge, can you exploit that by jacking up prices? How do you take advantage of this at a time when you see Amazon increasingly taking on share?
Look out for that conversation after the closing bell when we get those Amazon earnings a little bit later on this afternoon. Equity futures on the S&P still just about positive, but fading slowly. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Donald Trump posting on Truth Social just minutes ago about his plans for the Gaza Strip. Trump writing the Gaza Strip would be turned over to the United States by Israel at the conclusion of fighting. The Palestinian people will be settled in safer and more beautiful communities. Trump adding no U.S. soldiers would be needed for the operation. Meanwhile, Honeywell shares are sliding 4.5% in the pre-market after announcing plans to split into 3 separate publicly traded companies. Honeywell has been under pressure from activist investor Elliott Investment Management, which called for the split to boost shareholder value. The breakup process is expected to be completed by the second half of 2026. And Nissan shares traded higher in Japan after the company announced plans to seek a new partner as it prepares to end talks with Honda. Sources telling Bloomberg the new ally would ideally be from the U.S. tech sector. Nissan's board is also pushing for a restructuring plan, according to sources, and the goal is to come up with a much deeper revamp by February 13th. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program, counting down to payrolls.
It's very hard to know what's happening with growth and employment, what's happening with inflation until you get a little more clarity on all of these uncertainties. If you look at the last SEP, there's a lean in there, toward cutting.
Joining us next, Jonathan Pingle of Natixis from New York City. This is Bloomberg. Live from New York City, if you're just tuning in, good morning to you all. Later on today, earnings from Amazon after the closing bell. Later on this morning, 8:30 Eastern Time, jobless claims. Equity futures on the S&P 500 just about unchanged, following 2 days of gains. And the bond market yields are higher by a single basis point. The 10-year, 443. Under surveillance this morning, we're counting you down to payrolls.
It's very hard to know what's happening with growth and employment, what's happening with inflation, until you get a little more clarity on all of these uncertainties. I don't see any signs of an economy overheating. I think we've recalibrated to a place that is more sensible given where the economy sits right now. If you look at the last SEP, there's a lean in there, toward cutting.
A bias towards easing, a bias that he said wasn't kind of there, And there's no bias to hike either. What we got from Barkin yesterday, can we just pause for a second?
Yeah, sure.
That was a Fed official that just seemingly didn't want to say anything about the future at all across, a 6-7 minute interview?
Well, in fairness, how can they? Because right now, they don't have the clarity that anybody has, because nobody has clarity. Everyone comes on here and says, we have no clue. There was an interesting point that he made. What use is forward guidance at a time like this by the Federal Reserve? And is it still a tool if forward guidance is, we have no clue?
And a lot of people have no clue. And we've seen that from corporate America as well, from a couple of companies over the last few days who are just struggling to offer that guidance. And if they do, investors are struggling to believe it. We get some data later this week. We get payrolls. This is the outlook coming from Jonathan Pingle of Natixis, who writes, we estimate that non-farm payrolls rose by 240K in January, with private payrolls increasing 195,000. Jonathan joins us now for more. Jonathan, good to see you.
Good to see you as well, John.
Where does that number come from? Because 240 is pretty big, following a pretty big number in December.
Yeah, so I'll start with the fact that if you asked any economist what the hardest month to forecast payrolls is, they would say January, right? The post-holiday layoffs take around 2.8 million workers off payrolls, and then this is adjusted upwards by about 3 million workers to get that headline NFP print. That seasonal adjustment is, by definition, a huge source of error. And then on top of this is the month where you get the historical seasonals revised. So it's kind of like going into this with one eye blind. However, the last few Januaries, we've seen this very low layoff environment. And the low layoffs have really helped boost that January payrolls number.
You talked about the revisions, the sort of idea of how much they're going to change their 2024 jobs figures. I'm fascinated by that. How many jobs are we going to take off? Just how not good was last year, or how not amazing was last year, heading into this year at a time where some people were thinking that we were on the verge of overheating?
Yeah, it depends whether you're talking about payrolls or you're talking about the household survey estimates. If you're going to payrolls, it looks like the preliminary benchmark that we got back in August said that we were going to be down 818,000 jobs. I think looking at QCEW data, it's a little bit closer to a 700,000 downward adjustment that we'll see tomorrow. However, you look at the household survey, it's being revised up by about 2.7 million for population, 1.8 for actual job growth. But they're meeting in the middle, right? We're starting to get a bit clearer picture of what was actually going on last year.
You have a really unique way of talking about the payrolls numbers, and I'll tell you why. You don't start off by saying economy good, number X or Y. You talk about it as if it's a random number generator, and this is what goes into it, and this is what I think it's going to spit out. When you say things like, I expected to say 240, I don't hear from you the economy is pretty decent, this happened, that happened. I just hear this is what goes into the random number generator. This is what I think the number will be. That's really unique, by the way. And you've been very accurate on that front. What do you actually think the economy is doing away from that 240?
I think the economy is doing very well in this post-election period, but is going to be coming and slowing down, right? The past two payrolls, and including this one, I guess we're going to see a little bit of this, pre-election uncertainty unwind, right? December looked really good. And in some ways, as a business and as a firm, you didn't really know what was going to happen going into the election. You didn't know what industries were going to benefit, which industries were going to fail. And you really got a great sense of, or great clarity on, I can do hiring here, I can't do hiring here. And we think this really boosts these next couple months. But going forward, the actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
What are you looking for in particular to measure how much the Trump uncertainty is affecting a labor market? Is it having to do with just hiring plans more broadly, or is it having to do with, say, immigration and just simply supply of labor?
I mean, a lot of it's a growth effect. I think if you look at the sentiment changes that you got post-Trump and that really big sentiment boost, that really, I think, points to the really short term, right? And I forecast something that happened last month, right? Like payrolls is last month. This isn't a forward-looking indicator. However, it's the best shot we've got and the best picture we have at the moment. And as you go forward, you care a little bit more about, how does aggregate demand really interact with these things? How much does slowing immigration over the next few months going into Q2, how that affect the labor force there? How will demand externally and how will tariffs compete in certain ways, and how we figure that out as well?
So if you're seeing a loosening of the labor market at the same time, we're going to see less immigration come through. Potentially it remains status quo. Is that possible?
Well, I'd also like to characterize this January print as not necessarily just a great print, right? The skew on the seasonals doesn't necessarily mean everything's dandy and it's going to keep going on very well. This is more that we've seen this skew on the seasonals in January for the past couple of years, and it's an assessment that hopefully will happen again this year. And then it's tempered by cold weather, which I had a bit less of an impact estimate than others, and the wildfires. But going forward, I do think that you'll see a payroll impact estimate from slowing immigration, but it'll be kind of harder to figure out how that happens to actual unemployment.
So do you think at some point this is going to be a window this year for the Fed to cut?
I mean, I think if you're looking at the economy in a broad way and looking at just payrolls in a broad way, we've seen almost 2/3 of the hiring in two sectors, healthcare, social assistance, and leisure hospitality. Is an economy that's hiring in only two sectors what they really mean by maximum employment? Is that what they really mean by that mandate? And I think that's worth questioning, especially as we get inflation kind of slowing into May. I think that becomes the question.
You think there's more weakness there than maybe meets the eye on the surface of things?
Yeah. I also think that the sectorization creates a little bit more of a brittle labor market rather than everything going well. And I think there's further room to cool. And I think we see that here.
This is what Citi's Andrew Honhorst has said as well, that the narrowness, the breadth, the lack of breadth when it comes to job gains is inconsistent with a healthy labour market.
The idea that quits and that hires are both just staying at very low levels in this stagnant level. The idea of sector-specific hiring doesn't give people flexibility if they get laid off in a sector that isn't exactly hiring.
That together with that low churn you describe.
Yeah.
That's problematic. Let's put it that way. Jonathan, it's good to see you. Lots to talk about. Appreciate it, sir. That was a compliment, by the way. I enjoyed it. It's a unique take, a unique way of talking about the labour market numbers that we get.
And possibly more accurate at a time we're about to downgrade by almost 1 million jobs what we got last year. I mean, this to me highlights the lack of specificity that we really have to take.
Well, just to reiterate, Jonathan was the most accurate forecaster of payrolls through much of last year. Jonathan Pingle there of Natixis. The second, in case you missed it, was his dad. Up next on the programme, Jack Caffrey of JPMorgan Asset Management, Henrietta Treyz of Veda Partners, Geoff Meacham of Citi, and we'll catch up with the Port of Los Angeles Executive Director Gene Seroka on global trade and what tariffs mean for his business. He had a monster 2024. That conversation is just around the corner. The second hour of Bloomberg Surveillance, up next.
We think the U.S. economy is really strong, and it's really strong relative to the rest of the world.
We're still seeing strong trends when it comes to economic activity.
We've been saying that the labor markets have been holding up pretty well.
We still believe in the U.S. exceptionalism story on the growth fundamentals.
If you're a central banker in that situation, you're having to model growth down, inflation up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures just about unchanged on the S&P 500. On the Nasdaq, a little bit softer. We're down by a bit more than 0.1%. Later on today, big focus on the Nasdaq when we get earnings from Amazon. So look out for that. Before we get there, at 8:30 Eastern Time, we get some numbers, some data, jobless claims just around the corner. Coming up this hour, we'll catch up with Jack Caffrey of JPMorgan Asset Management on the latest earnings. We'll speak to Henrietta Treyz of Veda Partners as the Trump administration vows to extend tax cuts. And Gene Seroka, this is a must-watch one, up a little bit later, of the Port of Los Angeles on the risk for global trade. Before we get there, we need to talk about a Bank of England rate decision. They dropped rates by 25 basis points, Lisa, from 475 to 450.
And they did exactly as you expected, cutting growth forecasts and raising inflation forecasts. The breakdown was different than I thought. It was 7-2, not 8-1. You do get dissents from the Bank of England, and 2 people did dissent. Curious to see right now how they push this forward in terms of tariff uncertainty and how far they end up getting constrained by their bond market.
I can tell you sterling's weaker off the back of it, and we had some weakness going into it. Cable's down by 1 full percentage point. That is a weaker pound against the US dollar, 123.80. At the Bank of England, Bloomberg's Lizzie Burden has more. Lizzie, let's talk about this. The decision to drop interest rates 25 basis points, but the outlook, the change to the outlook, how problematic is that for a central banker?
It's a problem for central bankers, John, but let me just start with the vote split because my jaw is on the floor here. Catherine Mann, the arch hawk formerly of the committee, voting for voting for a half-point cut, along with Swati Dhingra, who was already the archdove of the committee. If I'm seeing these headlines correctly, this is a real swing, and we were expecting an 8-1 vote split, but to have these two voting for a half-point cut here really just shows the worries about growth in the economy. And remember that the Bank of England is meant to be focused on inflation here, but you mentioned the forecasts. It's not a good look for the Chancellor Rachel Reeves when the UK government's top priority is meant to be economic growth. The Chancellor's just announced this raft of measures to boost the economy, and they're looking at a weaker outlook for growth. They're looking at inflation staying higher for longer, essentially. It's a picture of stagflation. It is not what Rachel Reeves would want to hear.
And Lizzie, we can see that the response in the gilt market actually might be a bit of a relief to the Bank of England. You're seeing 10-year gilt yields come in just a touch. So it isn't necessarily giving people the sense that you're going to have some sort of resurgence in inflation. Going forward, how much are you expecting to hear about whether the tariff backdrop is going to weigh on this or whether this is just simply just because of the budget and the situation of stagnating employment and a real issue with growth?
Well, of course, the difficulty is they just don't know what's going to happen in terms of tariffs globally and specifically for the UK. For now, Keir Starmer is in Donald Trump's good books, but in any case, there will be an impact on the UK economy. Our economists at Bloomberg Economics say that if it's just avoiding direct tariffs on the UK, it'll hit growth. If you have direct tariffs on the UK, it'll also hit inflation, and that would put the BOE in a bind because it would be harder to rescue the economy. Andrew Bailey talks about how he loves free trade. I'm sure that that's what he will say in the press conference. But the difficulty is these forecasts may already be too rosy because they can't integrate policy that hasn't yet been set by Donald Trump.
Lizzie, I'd love to jump in and just get your thoughts on something. You know that I used to cover this central bank. I haven't lived there for 10 years. I'm not in the details like you are. But looking at this on the surface, this is a central bank with an inflation target of 2%. 2%. And they're forecasting inflation to drop below that to 1.9% in the first quarter of 2028. That's the first quarter of 2028, which raises an obvious question. Why are they doing this? Why are they cutting interest rates? Why are there some people on the committee voting to cut interest rates by 50 basis points? Why are they prioritising growth over inflation? And do they just believe that if they don't protect growth, something bad's going to happen? Do they acknowledge that if they support growth, inflation will stay elevated? What's the thinking behind all of this? And how will they explain that in a news conference?
That is exactly what's going through my mind, John. And this is why I talk about what their mandate is. they're focused on inflation, supposedly, but look at the problems in the labour market. It's been deteriorating rapidly since Rachel Reeves's budget, and that is what they are showing in these forecasts, the worries about unemployment to come. Clearly, they feel like they need to help out with growth because the Chancellor's raft of measures on the supply side aren't set to take an effect for decades, perhaps, to come.
Lizzie, appreciate the update. Lizzie Burden there of Bloomberg. The Bank of England cutting interest rates by 25 basis points, a reduction of 25 basis points. But the vote split, to Lizzie's point, was interesting to see two individuals look to cut interest rates by 50 basis points at a time when they had to upgrade the outlook, lift the outlook for inflation. That's a difficult one to explain a little bit later.
And you highlighted that tension, especially because this is not a dual mandate central bank. I will just note, and I keep going back to it, that UK 10-year yields are lower on the heels of this. So no one is expecting this to cause some sort of resurgence in inflation. But there is a theory that it is harder to get back jobs that are lost as a result of interest rates too high than bring down inflation that gets a little bit hotter than, say, 2%, especially if it's not above 3% for a longer period of time. The currency is a little bit of the rub. And this is going to be a confusing picture to really
I wonder
unwind.
if there's a message for the ECB in all of this as well. If they're doing this, if there are people on that committee signalling they would like to cut interest rates 50 basis points, your growth profile's not great either. Why aren't you doing the same thing?
Since when do German central bankers take advice from the Bank of England? But yes, I get your point. And there is this question about whether this is sort of a creeping dual mandate without saying it.
It's a healthy debate. Sterling right now is down by 1 full percentage point against the US dollar, 123.74. Let's bring it back to Wall Street with stocks looking to get a boost from earnings a little bit later, with Amazon reporting after the closing bell. Jack Caffrey of JPMorgan Asset Management writing this. Interesting times are more of a challenge for markets. There is extreme aversion to uncertainty, to the point that uncertainty can be paralysing to many. Jack joins us now for more. Jack, good morning, sir.
Good morning.
Let's talk about that line. We're starting to see some of that from officials who just do not know what to do in this moment.
Well, you're left with having to respond. No, you're having to react to a series of executive orders. I think we're at 40 plus at this point in time, several of which have been ruled unenforceable by judges or multiple judges. And so it's rather hard to figure out how do you allocate. Now, I think it's hard to sometimes allocate capital when I can change my mind quickly. It's a little bit more challenging if you're thinking about how do I allocate capital if I'm going to spend $100 million on building a data center. Am I going to be able to rebuild in Southern California based on where environmental rules might be, where labor markets might be? And so I think we might rewind a bit to 2018, 2019, when you actually got a tax cut that was supposed to stimulate growth, and then you got a trade war, which led the companies question where and how much I should actually be spending my money. And it's where companies want to spend their money that creates economic growth, that create job growth, that create the income, that ultimately pay the taxes that keeps this whole merry-go-round spinning.
Big tech has confidence to keep spending. They're spending in droves, and people aren't really liking it, even though they've got the conviction that the business will come and that really their biggest liability is just not spending enough. So why isn't it getting rewarded? You guys have certainty. Hallelujah.
I do think that there's a bit of a disconnect between what tech companies see and what they want to see. Certainly, if we go back to the late 1990s, I want to say it's Brian Arthur at Stanford came out with this idea that, you want to try to capture as much of the network as quickly as possible, and that you'll somehow achieve lock-in. And that, I think, leads to where you're hearing executives come back to this idea, if I build it, they will come. And a year ago, you were rewarded for if I build it, they will come. More recently, you're certainly seeing pushback from a couple of the big technology companies that have said, we will spend, and we're confident the demand will be there, trust us. It's that last line, I think, that has given some pause, and which has had some knock-on effects for all those other people who might be supplying, not just the building, but ultimately the GPUs. And then with DeepSeek a week and a half ago now, indicating maybe there are cheaper ways to achieve the same goals.
There's a lot of uncertainty right now on the policy front. And people seem to think that there's also a lot of uncertainty on the structural story around artificial intelligence, because that narrative has been flipping and flopping. Do you think that some of the sales of the nuts and bolts, the utilities, et cetera, around what we saw following DeepSeek, do you think that was overblown, or do you think that that is the beginning of a sort of right-sizing in people's expectations?
I actually think that we have to stage the challenge that we're experiencing. Because what we hear and continue to hear is that actually getting the GPUs remains challenging, but that when you're actually looking to build out a data center, you have to build the whole building first. You have to build the HVAC system, you have to secure the electricity. That's a big chunky spend, and that actually then installing the racks of servers is much more incremental. And so that you can actually have some dialing down of the spending intensity if the demand isn't there. But ultimately, when you sit back and think, I need to come up with X 100,000 square feet of space, I need to have it attached to a grid that has power, and I have to commit to that over a several-year period of time, that's a much bigger check that you have to write up front before you actually get to see the demand unfold. And so, for all the excitement around, GPUs and the intensity of getting those GPUs, they actually, not to say they're a variable cost, but they're much easier to roll out in much more measured units rather than a building.
Right, but if all of that's going to be built in America, are those kind of the sectors you want to be exposed to?
Well, the buildings are built in America. The chip itself is built in Taiwan.
But
there's a whole different issue that we
definitely. But there's a lot
have
of
to go down the path.
But there's a lot of grants from the Chips and Science Act coming to the United States that we haven't even seen fully put into fruition in the U.S. to build those chips here.
Up until last Monday, when we basically said no more grant money.
But Donald Trump is talking about $600 billion of this Stargate AI. There is a lot of excitement around this space within the United States.
There's massive enthusiasm, and I do think that, that's why we had tech in such a strong position last year. But certainly investors have been expressing some skepticism, and you can see that in the valuations. You can see that in how some of the stocks are trading and where we've seen some rotation. Take me back to things that I have greater certainty on. Your guest right before I joined was talking about so much of our hiring has been in healthcare and in hospitality. The U.S. economy is 60% consumption, 65% consumption. That's a flywheel. Once it starts turning, it continues to turn. And I would say, as much as we live for Employment Friday, Jobs Friday, realistically, it's Unemployment Thursday that probably is the more telling issue with respect to, is that flywheel continuing to turn? And so long as we keep seeing these low 200,000 initial jobless claims, I think it speaks to the U.S. economy, a consumption-oriented economy, and actually not really, we're big traders on a dollar basis, but in terms of as a percentage of GDP, that's not really our cup of tea.
8:30 Eastern time for jobless claims. The estimate in our survey, 213, so in the low 200s. Jack, give me something to get my hands around. Give me a theme. Are you playing the rotation? Which sectors are you going to? What are you doing right now?
I'm going to take some people at their word. I think healthcare has gotten very interesting. It's been absolutely hated for several years. It's lowest relative weight in the S&P, going back almost to Hillary care. For people who don't recall this gray hair as being earned and experienced. And I do think when you look through, we have this demographic issue, which actually means the U.S. is creating lots of healthcare consumers over the next several years. There's definitely some bifurcation in valuations. If you touch GLP-1s, we still love you. If you have some questions around your pipeline, you are trading at 8 or 9 times earnings, which is to say no expectations of growth in the foreseeable future. But I think coming back to companies that are tied to more stable policies like Medicare, where you've continued to say we will continue to protect a social security net for the old, which is earned in some sense, I think winds up being an investable theme. Where you're not being asked to pay very demanding valuations. You wind up staying away from tariffs, you stay away from trade. All of your labor force is domestic. I think there's opportunities there. And financials. While I can talk about government spending being somewhat paralyzed, corporate spending likely to be paralyzed over the next several months, the reality is the VIX continues to spike higher. Kind of interesting yesterday to see the TIPS ETF getting overbought, suggesting that some fixed income people are looking not just at yield levels, but what their compensation is within yields in terms of some risks out there. And so I think that fear or that episodic fear is good for trading activity and probably good for financials, who will also probably get a lighter regulatory touch for at least the next 2 years.
Most likely, that's for sure. It won't get any worse anyway. Jack, it's good to see you.
Thank you.
Great to catch up. Thank you, sir. Jack Caffrey there of JPMorgan Asset Management. Let's get you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Secretary of State Marco Rubio says he won't attend the G20 summit in Johannesburg this month. Among the reasons he cited was South Africa's attempts to promote equality, solidarity, and sustainability. The move adds strain to U.S.-South Africa relations, which have been tense due to South South Africa's close ties with China and its refusal to condemn Russia's invasion of Ukraine. Meanwhile, Ford shares are falling 5.8% in the pre-market. The automaker warned its profit could fall by $2 billion or more this year. Ford blaming the weakness on falling vehicle prices and costly new model launches. And on top of that, CEO Jim Farley told Bloomberg that President Trump's threatened tariffs could cost the industry billions of dollars. And shares of Qualcomm are falling 4.3% in the pre-market. The world's biggest seller of smartphone processors expects the overall smartphone market to be flat or increase in the low single digits in 2025. Analysts did note that the results for the first quarter were otherwise positive. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Trump agenda.
If we do not get this tax bill done, as I said in my Senate hearings, this is pass-fail for our side of the aisle, and we will have the largest tax hike in history. Largest tax hike in history.
That conversation up next with Henrietta Treyz of Veda Partners. Live from New York City this morning. Good morning. Stock slightly positive by 0.05% on the S&P. Bond yields a little bit higher by 2 basis points, 443.62. Under surveillance this morning, the Trump agenda.
If we do not get this tax bill done, as I said in my Senate hearings, this is pass-fail for our side of the aisle, and we will have the largest tax hike in history. Largest tax hike in history, and that will be on the people on our side who do not try to move this forward. In theory, tariffs would be a shrinking ice cube. Tariffs are a means to an end to reshore economic security in the U.S.
So here's the latest this morning. President Trump set to meet with GOP lawmakers later on today. The meeting coming after Senate Republicans broke with the House over the president's budget strategy. Henrietta Treyz of Veda Partners writing, the budget resolution will contain hard and fast deficit authorizations. So the real test will be in the text of the budget resolution the committee marks up next week. Henrietta joins us right now for more. Henrietta, walk us through the process. Why is this process so important?
Yeah, the process is everything. All eyes should be on Lindsey Graham and the Senate Budget Committee. He is going to move forward with one small bill associated with military and immigration spending and energy component. And that's going to be the first bill that President Trump passes in the first half of 2025. It's going to take all year to write the tax bill. The tax bill also will have to go through the budget process. And that is the first step for any legislation that Republicans want to pass without Democratic votes this year. And it's going to be very hard fought and take the next 12 months.
Henrietta, I want to talk about tariffs as a revenue raiser that politically Republicans want to use to offset the tax cuts. Scott Bessent, Treasury Secretary to Larry Kudlow, is talking about the fact that this is a means to an end. But I caught up with Peter Navarro yesterday and Jason Smith of House Ways and Means, and both of them were talking about the External Revenue Service as a new place to be able to collect those tariffs to offset these tax cuts. Which one is it?
Yeah, you cannot have it both ways. You can't have a declining amount of tariff revenue and also a rising number of revenue components to pay for this tax bill. The tax bill is going to be a minimum of $5 trillion. If you're going to try to factor in $1 trillion in revenue from tariffs, you must implement the tariffs. And indeed, you have to have the tariffs escalate to accommodate the manufacturing supply chain shifts, consumer behavior shifts, obviously retaliation that we know is coming from other nations. So when it comes to lawmakers factoring in the tariffs, I think there's a really small basket of stuff that they can do via legislation that will officially score in their tax bill. The de minimis exemption, maybe even stripping China of its PNTR status, which is about a 40% prospect in my opinion. But those are the two pieces that can pass. For the rest of it, they're talking about $50 billion in bailouts for farmers because the trade war is going to be so aggressive. So, you really have to pick one. You can't have it both ways.
Right. And we saw the biggest bailout of Trump 1.0 go to the farmers, bigger than the auto industry because of the retaliatory effects of China. Something else Scott Bessent said in this interview, the goal is still for them to be made permanent, the tax cuts. Can the Republican Congress do that?
No, I don't think so. My odds of this being a temporary bill are quite high and rising that they will have to negotiate with Democrats at the end of the year. And it's now at 30% odds prospect. And here's why. when you talk about a $5 trillion bill, which is not even factoring in the wholesale no taxes on tips and no taxes on Social Security components that President Trump continues to tout, you do not have the votes for the magnitude of deficit reduction or offsets to cover that cost. The easiest way out of that quagmire is to truncate the duration of the bill. That's exactly why the tax cuts expire at the end of this year in the first place. In 2017, they only had $1.5 trillion in deficit authorization to work with, and that meant that the individual tax rates were going to expire. That's exactly what we're walking into this time around.
We've talked a lot, Henrietta, about what can get passed. And yet what we have seen from this Congress, the Republicans on both sides, is they're not willing, at least initially, to push back against Donald Trump's agenda in almost any way. Are we overestimating how much pushback there is going to be, and potentially are we underestimating how easy it is going to be to pass some sort of budget bill at a time where there does seem to be quite a bit of unity?
You know, I actually think that that is an incredible point. It's just that I reached the opposite conclusion. The reason all these confrontational nominees are sailing through is because of the legislative train wreck headed our way. And I think that what we're seeing in terms of them stepping aside for the OMB director, who is plainly supportive of challenging the Impoundment Act and other things that members of key committees don't like, is because it's about to get very rocky from here. When you hear Scott Bessent, the Treasury Secretary, say, I want to use current policy baseline, that's fine. You could say you want to use it, but it's not permitted under Senate legislation and Senate rules. And they're going to have to confront the hard reality of the Byrd rule in a couple weeks' time, especially when we get to the tax bill. And so you can want it whichever way you're hoping for, and you can jawbone about current policy and say these tax cuts pay for themselves. This is a $3 trillion revenue raiser. But reality is going to hit you like a ton of bricks when you get in front of the parliamentarian of the United States Senate, and you have to find offsets or truncate the cost of the bill. And that negative reality that is going to be very immediate, as opposed to working through court cases, as we're seeing with DOJ and the other components, is going to be immediate. And I think that that's something that the lawmakers know, they're very aware of, and the Trump administration is about to find out.
Henrietta, we just have about a minute, but are you basically saying that some of these Republican Congress members are allowing some of the nominees to go through because they want to have the president's ear to adjust the budget negotiations as things get ugly?
Absolutely. I think it makes perfect sense. I mean, things are about to get incredibly rocky. You're seeing the intra-party divide between House Republicans and Senate Republicans right now. Whether it's Jason Smith and Ways and Means and Mike Crapo in Senate Finance, they have two competing agendas, mostly because Jason Smith is very concerned that he cannot get a tax bill through his chamber without the sweetener of border security and immigration spending and military spend. And Mike Crapo thinks that they can't get anything done for 12 months, and they want to use a current policy baseline, which means they don't have the votes in the House. So that intra-party war that has been around for 20 years, if not more, is about to come to the surface. We're just not seeing it because it's week 3 of the administration, and they're acting on executive actions, not legislative. And that's going to change.
It is only week 3. Then we have to repeat that daily at the moment. Henrietta, thank you. Henrietta Treyz of Veda Partners with a clinic on a process. The 10-year yield might want a word as well. The 10-year at the moment is down to 444. Down 40 basis points. BMO's Ian Lincoln reminds me, down 40 basis points from the highs of January.
A retracement of some of the inflation fears, but also a reigniting of some of the disinflation. I just want to say it's a beautiful thing, the 10-year. Let's focus on it.
The president's very focused on the 10-year yield.
I think he should be.
There you go. Up next, Geoff Meacham of Citi on the outlook for pharmaceuticals, with Robert Kennedy Jr. on track to become Health and Human Services Secretary. Equity futures on the S&P positive here by close to 0.1%. Moving the other way on the Nasdaq 100, we're down by 0.1%. No drama so far this Thursday morning. Good morning to you all. We're 2 hours until the opening bell. Let's get you some morning movers. Let's say good morning to Manus Cranny. Morning, Manus.
John, and a very good morning to you. When it comes to a conglomerate like Honeywell, it's time to break up the gang. We knew this was possibly coming. Elliott, the activist investor, took a $5 billion stake in this company. That was revealed in the autumn. And they're getting what they want, which is split up to try and boost the valuation. You've got this stock trading on 21.5 times earnings per share for this year. And then you look at GE, trading at 38. So what do we get? Automation, aerospace, and materials. That's the trifecta. That's the breakup. Big part of the beast is, of course, automation, worth $18 billion. But then, of course, you get the actual numbers and the guidance, and they're missing on multiple fronts. They're missing in terms of the forward guidance on earnings per share, sales, and free cash flow. That's almost a validation of the narrative from Elliott. Either way, breaking up, it's never easy to do. Just take a look at GE and the valuation that subsequently came through there. Ford, again, guidance is everything. We're going to have price cuts on the cars. It's going to cost us more money to develop the new lineup, the Lincoln Navigator and the Ford Expedition. So profit's going to drop by about $2 billion. So they're going to make between 7 to 8.5. Originally, that was in the tens. Originally, that was double digits. Tariffs, CEO Jim Farley was with Bloomberg yesterday. Billions and billions of dollars are the costs. That's the risk. And jobs here in the United States of America. He wants a reasoned discussion around tariffs and keeping some of those tax credits for producing in the USA. Right now, on the back foot. Qualcomm. You've had big tech, now it's all about the chips. And you think about it, this company, 75% of their revenue comes from handsets, from smartphones. Now, that business actually had a pretty hot additional quarter, 3 quarters in a row. It's been running quite hot. But it's about the slowing trajectory of that smartphone growth. That is what they see as being flat to increasing single digits. We talked about the lack of the upgrade cycle in the Apple story, but here's a qualification of some of the headwinds, perhaps to the consumer, and they exclude the renegotiation that they're doing with Huawei. So it's a feast really in terms of that whole smartphone discussion. Jonathan.
Manus, thank you, appreciate it. Manus on some stocks to watch and a little bit of relationship counselling along the way. And our radar this morning. Amazon set to report earnings after the closing ban. Investors focusing on the cloud business and online sales for the holiday shopping season. Cloud growth will be key after disappointments in the space from the likes of Alphabet and from Microsoft as well.
And they are really the big player with AWS capturing such a big part of the share. So how much are they seeing the same type of demand outstripping supply? I keep harping on this. I'm trying to make this story relevant. But I'm looking at what kind of efficiencies they're going to be talking about, because Andy Jassy put out a 1,400-word manifesto talking about cutting middle management with some of the efficiencies through machine learning. Do we see some of those layoffs to justify the payment for some of the capital expenditures? That, I think, is going to be an increasing theme.
I'm interested to know what's going on in trade. We talked about this earlier. Morgan Stanley saying that Amazon could be one of the biggest e-commerce giants hit when it comes to the 10% tariff. But then you brought up a great point. This de minimis exemption means some of their biggest competitors from China, like Temu and Shein, they're the ones that are going to be hurt the most when it comes to making sure those tariffs are on products that are less than $800.
Net benefit or net negative? Does it help them or hurt them? Maybe they'll give us some commentary a little bit later. I want to turn to Google, but not about the earnings. Google is the latest tech company to drop diversity goals. In a note seen by Bloomberg, workers were told the company would no longer have aspirational goals tied to representation. Google going on to say it is committed to creating a workplace where all employees can succeed.
Some of these were put into place in 2020 following the Black Lives Matter protests. There, they looked to target a higher proportion of their staffs as being people of color, people of different ethnic backgrounds. This comes as they and others come under a lot of pressure from states like Oklahoma, who are suing them to try to say that they are not being constitutional. Expect to see more in this space, a really difficult dance, especially for tech companies that traditionally have been the bastion of some of these policies.
It also comes as Trump has basically made it clear within the federal government and also companies to what he calls root out illegal DEI. And Google is not just the first one to do this. We've seen this from a number of companies saying we are actually going to pull that back and focus on meritocracy and take all that language out.
It's the E where some controversy seems to be, the equity side of things. There seems to be a refocus, and of course they've got to navigate the legal issues as well, but there's certainly been a refocus in this country, in corporate America, to go back to the foundations of what this country was really all about. Equality of opportunity, not outcome. That's got to be the shift, and the shift that we're seeing from corporate America at the moment.
The way that a lot of diversity programs are put into place was through benchmarks, hitting certain benchmarks. It seems as if the shift, and this really started with affirmative action with respect to college admissions, has been retrenched in a pretty significant way by the Supreme Court. You're seeing that now trickle out into a lot of the outward policies of a lot of corporate America.
Let's turn elsewhere. On the government, this is a big focus too. More than 40,000 federal workers taking the Trump administration's offer to leave their positions with pay through September. An official at the Office of Personnel Management telling Bloomberg the number is expected to surge ahead of today's deadline.
I think for a lot of these federal workers, they also just want clarity to make sure that they will get paid for those months that were promised. And then potentially if they get more of that clarity, you could see the numbers go up. I will say $40,000 people sounds like a lot. Actually, it's below what their target is. So they do want to ramp that up before it ends because they want to be able to hit those targets. It's a huge part of the Trump administration's DOGE effort to make the government smaller and more efficient.
On April 30th is 100-day mark. I looked it up yesterday. I might be getting it wrong. It is April 30th, right?
I think so.
Okay, great. But what I want to do...
Put on the spot like that.
I didn't count the calendar days.
I count the calendar days.
We trust you.
Because I wanted to take a look at just how much has been changed at the federal government level, because we've heard all of this in terms of efficiency, in terms of cutting personnel, in terms of eliminating entire budget, entire departments. I want to understand how it shakes out, what gets challenged and what actually gets through.
The USA debate right now I find absolutely fascinating. Disappointing to see Washington do what Washington always does, become tribal. Not be open-minded that maybe both sides have got a point. We can have a conversation about soft power, the need for soft power, the influence of seeing emerging from China. You talked about Latin America recently. We've talked about Africa for a long time, the amount of influence that China has there. We can have a good conversation about that. But at the same time, when Republicans demonstrate the amount of waste that's coming from there, some of the initiatives where taxpayer money has been going, you need to be able to sit there and be open-minded. Park the tribal politics and acknowledge that maybe that X, Y, and Z, what Caroline Leavitt, the press secretary, has gone through, is not a good use of taxpayers' money. Maybe we can be open-minded about that. At the same time, perhaps we can have a conversation about the need for soft power. But at the moment, the politicians in Washington are just talking past each other. This idea they're going to fight against what? What are they fighting against?
The problem right now is that when nuance leaves the room, how much gets squandered at the same time, both on the waste side of things with programs that might not necessarily be necessary and that are wasting money, and on the need to be a counterweight to, say, China, in Peru, in Chile, in Argentina, going in there and making a real big presence to gain some footholds in some of the precious metals, et cetera. I think it's a really important point.
Which is something Secretary Rubio is trying to do, but in a very different way.
Yeah, what he's trying to do is, well, actually, he's going to basically take over USA and he's going to look by it. What they say is they're going to go line by line. I think there's also some Republicans, maybe not as loud, but there are some Republicans who say there's a ton of waste out there. We need to look into that. But there's others who also, maybe behind scenes, are saying there are projects we want to make sure we are protecting, especially those that are very hawkish when it comes to places like China.
Some amazing headlines on that front over the past few weeks, that's for sure. Let's turn to the healthcare industry. Robert F. Kennedy Jr. set to face a full Senate vote to become the health secretary after winning the endorsement of the Senate Finance Committee. Geoff Meacham of Citi writing the following: the executive orders over the past few days have shaken investors, and we acknowledge moving RFK Jr.'s nomination to the next step is likely to introduce further volatility. Geoff joins us now for more. Geoff, welcome to the programme. Wanted to get into this with you. You know far more about this than we do. So just off the top, if he's confirmed, what kind of control does he have that would influence outcomes for some of the companies that you cover?
Yeah, good morning. It's a great question, and thanks for having me. Yeah, I would say in general, what we learned in the committee hearing for RFKJ was really, the reiteration of prior policies. I think what you say on podcasts, pre-election is maybe different on how you govern. So things like, vaccines, I think the policies there, may be a little bit more controversial, but I wouldn't expect, for example, the Inflation Reduction Act, the discounting mechanism for that to be dramatically negative beyond current expectations. I think the stocks, and you saw pharma rally a little bit yesterday, just given the fact that, we may have hit a bottom here with respect to sentiment and risk of potential policy changes.
Geoff, we've been talking extensively about the dueling priorities of this administration. On one hand, deregulation. On the other hand, this idea of resetting expectations about what's allowed. This really is highlighted in the healthcare sector, where you have new drugs that are coming out and potentially even faster because of different machine learning systems. With a government that wants to deregulate, do you think that RFK Jr. wants to lean into passing things quickly, or is probably going to hang up some of the new developments?
I think it's more likely to be the latter, just because you'll have new administrations, new leadership at CMS, at CDC, at HHS, including obviously RFKJ, and FDA. And so I think under this scenario, typically what you get, and this goes back to sort of historical trends, is a little bit of a right sizing, new middle management, new decisions. So. But I think your first point is exactly right. Even Trump knows that the U.S. biopharma industry by far is one of the most innovative in the U.S. And so no one really wants to stop or slow that down. But I think you'll see maybe a natural, kind of slowdown in the first, call it, 3 to 6 months. Beyond that, though, I think we'll be off to the races.
There also is an effort to really reduce costs, and this comes at a time where one of the biggest debates in your industry is whether Medicare and Medicaid are going to cover GLP-1 drugs and whether you're going to really enter into a negotiation. Do you see this administration as more amenable or less to that type of discussion?
I think it's probably more amenable to discounting through GLP-1s, but I think the main issue is that we know this going back to Novo's SELECT trial from a year or so ago, that it's not just the GLP-1 drugs are not just about weight loss. They really reduce risk of cardiovascular death, of heart attack, of stroke, and they also reduce, blood pressure, lipids. So they have a totality of benefit and beyond just obesity and diabetes, and so I think that just that fact alone would make, I think, most administrators in D.C. want to expand the use of these drugs, albeit maybe at a measured pace initially through discounting. But at the end of the day, this is a very, very profound class that's going to have, activity and a bunch of indications across the biopharma space.
Geoff, I also want to talk about debate happening in Congress right now about the Inflation Reduction Act, which allows Medicare to negotiate prices for certain prescription drugs. Do you see this as a massive headwind for the rest of the year? And which pharmaceuticals could benefit or not benefit from this?
Yeah, good question. So the Inflation Reduction Act, we already have a mechanism for direct negotiation between CMS and drug companies. That was last year, and as it turns out, the level of discounting in 2026 with the first 10 drugs wasn't that bad. To 27, we now know the next 15 drugs, but it's still the old school negotiation. Old school meaning as of policy as of a year or so ago. The only new sort of element to this is whether Trump and RFKJ, assuming he's confirmed, want a more aggressive negotiation. And I don't know the benchmark here. I've heard everything from, most favored nation pricing to highest price across the G20 or lowest price across the G20. But either way, though, I think if you have a really aggressive mechanism for discounting, I think you'll stifle innovation. And I think Trump sees that. And maybe that's because a lot of the leadership from pharma, prior to the inauguration went down to Mar-a-Lago and had a discussion and sort of made the administration more realistic in terms of how they really want to view the pharma industry. You just don't want to, I think, stem, as I said earlier, the tide of innovation that we're seeing across the space.
Hey, right. Geoff, appreciate your input, sir. We're going to leave it there. Geoff Meacham there of Citi with the latest. Geoff, thank you. Come back on soon and we'll talk about this a little bit more. Equity futures right now, the S&P positive here by 0.1%. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. allies expect the Trump administration to present a long-awaited plan to end Russia's war on Ukraine at the Munich Security Conference next week. The blueprint is set to be presented to allies by Special Representative Keith Kellogg and includes potentially freezing the conflict and leaving territory occupied by Russian forces in limbo while providing Ukraine security guarantees. Meanwhile, SoftBank is in talks to acquire Ampere Computing. Sources tell Bloomberg talks are in advanced stages for a deal that may value the chip designer at about $6.5 billion, including debt. This is the latest deal in a wave of chip companies looking to capitalize on the AI spending boom. A transaction may be announced in the coming weeks. And the Bank of England cut its key interest rate by 1/4 point to 4.5%, but struck a hawkish tone. The central bank signaling that only 2 more reductions are needed to bring inflation to its 2% target. 7 of the 9 members voted for the 1/4 point cut, but 2 wanted a 1/2 point reduction. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, navigating trade uncertainty.
The tariff environment is obviously evolving here on a daily basis. That's how would this work through the system that we really try to help, the policymakers understand.
That conversation continues. Up next, we'll catch up with Jean Seroka of the Port of Los Angeles. Look out for that conversation in just a moment. Equity futures right now on the S&P bouncing back. We're positive by a little more than 0.1%. Under surveillance this morning, navigating trade uncertainty.
The tariff environment is obviously evolving here on a daily basis. If you see sanctions on Canadian or tariffs on Canadian or Mexican oil, that may send some of that oil to other countries. And so the Venezuelan oil could be even more important. So it's things like that. It's how would this work through the system that we really try to help, the policymakers understand.
So here's the latest this morning. The flow of global trade uncertain as the world awaits clarity on President Donald Trump's tariffs. Jean Seroka, the executive director of the Port of Los Angeles, writing strong economy, consumer spending and front-loading of cargo ahead of potential tariffs are helping to drive LA volume. Jean joins us now for more. Jean, it's good to see you.
Good morning, John.
You had a big 24. Let's start there. Can you tell us how much of that was about a good economy versus just front-loading ahead of this mess?
Well, John, as you know, not one variable drives the cargo volume through the port, but that underlying economy and the length of that stretch has been just tremendous. Then in the summertime, during campaign season, we started to hear from importers saying, you know what, just in case, we'll see how November elections go. I'm going to start to bring in a little bit more cargo and a little bit more. And that turned out to be true. Even our January numbers of cargo leaving Asia before Lunar New Year, probably the strongest on record.
Can you compare 24 to, say, 2021 and your ability to deal with that much volume and how much things have changed? What's changed at the port?
Yeah, I think we got a lot smarter. We worked a lot closer with stakeholders. For example, last summertime during the traditional peak season, we moved more cargo than at any other point in time, including those COVID years, and not one ship was backed up. So I think it's more communication across lines from shipping lines to terminals, truckers, railroads, as well as being able to see the cargo ahead of time. Our port community system, the Port Optimizer, now sees that cargo 40 days before it lands in Los Angeles, giving us time to plan much better.
Was there a tell in where some of these cargo ships were front-loaded from at a time when there was a lot of pretty heated campaign rhetoric?
Yeah, China, Lisa. Absolutely. Because during the campaign, there was talk about not only Canada and Mexico, but China. And at one point, it was $3 trillion worth of American imports that were at risk of having tariffs levied against them. So you started to see more and more folks hedge. But China makes up still 45% of our portfolio at the Port of Los Angeles. That was the biggest and most noticeable attraction to pulling that cargo forward.
Can you just give us a sense of how much it went up during those months and how elevated imports to the U.S. from China have increased in the past 6 months, given some of the expectation of tariffs?
Yeah, we had our second busiest year in the 117-year history in 2024. And the back half of the year was exceptionally strong because we didn't see a lull from the traditional peak season of summer goods that come in ahead of the year-end holidays. November, December, and now January in excess of 900,000 container units, best all time.
Okay, Jean, but now there's an extra 10% tariff on imports coming from China. What are you expecting?
Well, Annmarie, I think in the second half of the year, we'll probably see a dip in cargo. And it'll be cyclical, nothing to really panic about. But with all that product here and the price points better than they would be with the additional tariffs levied, probably just a little trickling down overall, probably 10% less than last year at that time.
The president is also talking about how Europe's going to be next. And in 2019, it was brief, but he did put tariffs on things like French wines, Italian cheeses. How do you game this out for the rest of the year?
Now, a couple things. I think obviously a lot of people are talking about prices, both wholesale and retail, what impact that will have. Are folks going to suddenly increase their prices just knowing that the next landing of cargo is going to be elevated and try to get ahead of that? A little bit closer to home, I look at the jobs associated with the cargo. If our cargo starts dipping down, for every container we bring in, for every 4 containers we bring in, it means one job. So you look at the truck community, the dock workers, et cetera. Again, cyclical and maybe short, but we still look at that. And then equally as important as we're planning right now on the recovery in locations like Pacific Palisades and Altadena, 14,000 homes were burned. We've got to get lumber and cement and workers in to help to start rebuild those communities. So those are the pieces that I'm watching right now.
How difficult is that rebuild effort going to be? You're right there.
Yeah, it's
right in the middle of it. How hard is it going to be?
John, it's going to be super tough. I'm really pleased with the federal response, the state folks on the ground in Mayor Bass in Los Angeles, as well as our county supervisors, led by Catherine Barger. But these are entrenched communities that now have to be cleaned up. Families have to evaluate, can they rebuild? Do they want to rebuild? But the all-out effort of that federal, state, and local response has been good. Now that private sector has to come in behind and really keep the pace going.
And some of those people just won't go back. I wanted to finish with you on something much, much bigger picture. So globalization is, of course, something that your business has benefited greatly from. What we've seen is a lot of people get left behind. And what we've seen from politicians is, quite rightly in some cases, a disappointment that there wasn't reciprocity with places like China. I want to understand from your perspective where you see the world going. How are things changing? What does the post-globalization world look like from your vantage point?
Yeah, I think a couple of pieces. One, 90% of trade moves on water. That's really important to us. The cargo coming through Los Angeles gets to every congressional district in the nation. If that cargo starts to move, sourcing changes, we have to be nimble enough, as we've shown over the past 6 years, to follow that cargo and chase it. Be anticipatory of where it's going to be coming from so we can set up. The speed component for the Port of Los Angeles has been our go-to-market play, and it's got to continue. Even with Mexico's manufacturing rising, we're playing strongly in the maquiladora areas.
What's the relationship between what goes through the Panama Canal and what could go to you?
Interestingly enough, we saw that over the past year with the elongated dock workers negotiation here on the East and Gulf Coast. We saw about a 3 or 4 percentage point market share uptick coming our way. I think there's a lot more opportunity.
Have you kept it? Have you held on to that?
So far. Now, it's early days because that contract was just agreed upon in a tentative state back in the early part of January, but we're doing everything we can to keep all that cargo stay in our place.
The politics of that part of the world, pretty interesting as well. Gene, it's good to see you, sir. Thanks for dropping by. Gene Seroka there at the Port of Los Angeles on global trade, Lisa, in a post-globalization world.
Although what's interesting about what he just said, it was quite the opposite at the end of last year as people were concerned about tariffs, that the more that threat is sort of on the horizon, the more people import to get ahead of it. So you can just imagine this sort of pushing it down the road and this constant front loading that might continue.
Well, this is what Zero Hedge was talking about when all of this data was coming out. They were saying this is just perpetual stimulus. If you think the tariffs are coming, you just spend and you bulk up and you backfill to get it on a better price.
You keep front loading. Some of those companies that did that, by the way, got caught wrong-footed. Remember Target?
Yeah, well, that was last year. This year, let's see.
That was an inventory landmine, that's for sure. Coming up on the programme, Darrell Cronk of Wells Fargo, the LinkedIn co-founder, Reid Hoffman, Sonia Meskin of UBS, and Thierry Wizman of Macquarie. The third hour of Bloomberg Surveillance, just around the corner.
Lots of uncertainty. It's the risk-off trade. No one wants to lever up.
Right now, it is business as usual, but maybe a little bit of a bird on the shoulder of uncertainty.
The volatility is not just in the equity market. Now it's cross-asset.
You're going to get an environment that is attractive for investment.
There are areas where you can look at the valuations and go, this is completely reasonable. But it is definitely more of a nimbleness, and you have to be watching things much more closely.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance starts right now with equity futures positive by 0.2% on the S&P 500. In the Nasdaq 100, we look like this. We're just about negative by not even 0.1%. On a Russell, positive by 0.3. In 30 minutes' time, it's all about the economic data. Jobless claims just around the corner, ahead of payrolls tomorrow. The estimate in our survey for claims, 213. For payrolls, 170. Then later on, after the closing bell, we hear from Amazon. Before we get there, got to talk about the labour data and the focus of this administration, not on the stock market, but on fixed income.
Let's just talk about the 10-year Treasury yield for the rest of the year, because that is what Scott Bessent is looking at. And frankly, that is the correct thing to be looking at. Completely unbiased view. Look, People have been saying that in this term of the administration, it will be the bond market that offers the biggest check at a time where inflation is coming off a higher boiling point, and you have a real question about just how much the U.S. can increase its deficit. Will this be the constraining feature to some of the pro-growth measures that we have not yet seen rolled out at a time where we already have seen a lot of tariff talk?
I'm just going to say it's going to be a long year then, when Lisa every day is saying how the 10-year yield is basically, the most important thing, and now she has Scott Bessent to thank for that.
More cowbell.
What I will say is tax cuts are going to mean higher deficits, which mean you need higher yields to finance them. And in the same interview with Larry Kudlow, Scott Bessent was talking about the fact that he wants to make the tax cuts permanent. This is going to be expensive, let alone let's not even discuss if they have the votes for that.
Non-inflationary growth is difficult to achieve. There are several ways of doing it. The previous administration took advantage, benefited from mass illegal immigration. And that's essentially what it was. Just huge amounts of undocumented workers coming into this country, a big boost to the supply side of the labour market. That allowed them to deliver non-inflationary growth towards the end of the administration, the first term for President Biden, and of course, the last term. In a second term for President Donald Trump to achieve this by not going down the same road they did, but by going down the energy path is an intriguing one. Makes sense on the surface of things. Get energy prices down, you'll be able to do things elsewhere, rates should fall. How do you get energy prices down? How will they boost supply in this country?
It's a great question. We had Mike Wirth on from Chevron yesterday. There's a lot of pro-oil and gas and energy talk. Has there been anything on the ground to really increase the production? Not necessarily. It is an interesting point at a time where efficiency is becoming the tool to offset a lot of the extra expenditures. We're seeing this in corporate America, and we're seeing this in the government. Does that lead to a real slowdown, though, in the labor market at a time where some people are saying we're already on a softening path?
There's also inconsistencies with this idea to get energy prices down. What matters more, foreign policy and tariffs or energy prices? Because you're doing maximum pressure campaign on Iran. You're talking about tariffs from Canadian crude. You're talking about maybe pushing Russia to force them to the table by trying to snap some of those tankers off the global market. There's a lot of inconsistencies, which actually might mean you could see energy prices higher, even though they want to drill, baby, drill.
It's a really interesting moment for the American economy and the American bond market too. Just for Lisa, the 10-year yield right now higher by 3 basis points, the 10-year 4.45. You'll hear more from Scott Bessent a little bit later, the Treasury Secretary, sitting down with one of our print reporters down in Washington, D.C. Look out for that on Bloomberg TV and on Bloomberg Radio. He'll be catching up with Sonia Meskin a little bit later. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo on optimism for US markets, Reid Hoffman of Greylock on big spending for AI, and Sonia Meskin of UBS looking ahead to payrolls. We begin this hour with stocks looking for a third straight day of gains. Darrell Cronk of Wells Fargo with optimism ahead, writing this: we expect stock prices to march hard by year-end, driven primarily by earnings growth that should broaden to more cyclically oriented areas. Darrell joins us now for more. Darrell, good to see you.
You too, John.
Bit of heat coming out of the American story. It's not bad, just a little bit of heat coming out. ISM services, job openings, we'll get claims later, payrolls tomorrow. Is that a good thing?
I think it's a good thing. You want that economic growth. I mean, we walked into this year thinking the economy would run hotter than most of our friends up and down Wall Street, right? So we were a good half a point above in economic growth. We thought rates would be higher. We thought inflation would be meaningfully higher than the consensus. We were almost a full point ahead of everybody else on year-end CPI for 2025. And we think earnings will deliver. I mean, you're already seeing it here in the fourth quarter. We're on a run rate of about 5% revenue growth and just over 10% earnings growth. 5% revenue growth is the real element, I think, right? Because you can drive that down, in operating leverage through the margins and straight to the bottom line. So if you can maintain that kind of revenue growth and get decent nominal growth, let's call it 2.5% GDP growth with we're going to say 3 to 3.5% inflation. Our year-end target's 3.3. That's 5.5%, 6% nominal.
If you think that the economy was run hot last year, is some of the uncertainty that we see right now coming from policy that hampers corporate spending, is that a feature, not a bug, to help with the disinflationary process where otherwise some of these pro-growth policies could be somewhat inflationary?
I guess the way we've thought about it, Lisa, is when the dust settles at year end, the positive policy impacts need to outweigh the negatives, right? And you've got both ends of it, right? So you've got tariffs and immigration you can call negative, and you can call deregulation and tax cuts positive, right? We haven't got to the latter yet, right? We're still kind of stewing on it. We've been all about, early days, tariffs, what we do, control of the border, all that stuff. So ironically, the markets have weathered that quite well, right? I mean, we're sitting here in a tight band, whether you look at the stock market, the bond market, right, which we're talking about with the 10-year.
Thank you.
I mean, remember that, when the Feds first started cutting rates in September of last year, September 18th, the 10-year was 370, right? It's 445 today. All of that's term premium, right? Because the long end of the curve is term premium, a growth premium, and an inflation premium. Almost 55% or 55 basis points of that's term premium, which is just a function of the uncertainty around the policy.
Okay,
right?
so if you do get some of that term premium taken out of the system, if you have longer term yields return to sort of where they were back on September 18th, how much is that part of your call for the broadening out? How important is that to see the rotation out of just some of the Magnificent Seven stocks into the rest of the index?
Well, certainly. So what I would say is this, like when you think about 2025 and what has to happen, you've got two fives that need to happen. 10-year needs to stay below 5%, right? Unemployment rate needs to stay below 5%, right? Earnings growth needs to deliver, and earnings breadth needs to broaden out, to your point. Inflation needs to stay less than 3.5%. The dollar, if you want to measure it by the DXY, needs to stay below 110, right? And the positives of policy need to outweigh the negatives, right? If you get those things to happen, I think you're in a good place and markets can do quite well. Any one of those spiking above some of those thresholds start to inject risk into outlooks and the system, basically.
I want to pick up on your point about tariffs and how you're saying the market's weathering it pretty well. But isn't the market just pricing in the fact that there will be 11th hour deals like we saw with Canada and Mexico?
Yeah, I mean, I think you have to separate, right, the old adage of like, you got to take President Trump seriously, but not literally. We're learning that quickly, right? Not all tariffs are created equal, right? Remember Trump 1.0, the tariffs were very surgical, right? It was washing machine parts, solar panels, and steel and aluminum. This time they're very broad. They're like a stick, right? 25% on Canada, 25% on Mexico, 10% on China. They're at the country level, right? So we're using the emergency powers instead of 301, 232 powers this time, right? Which is a very different equation. I think when it's all said and done, the Canada, Mexico, and call it the friends tariffs, including the Eurozone, are more about leverage and getting what you want. China is more about geopolitics, right? That's where the real rub is with China. And I would expect the durability of the Chinese tariffs to stick and stay. And that means very specific things for certain industries, right? We still get most of our tech hardware and a lot of our semis from parts of China, right? Autos are a big element there. Metals, energy prices, those are the areas. So it's gonna come down to those segments, sectors, and industries where the tariffs are going to matter as they get applied.
Are you concerned at that point then about inflation rising? Because this is the opening salvo when it comes to Chinese tariffs.
Yeah, I mean, as I said, I think the inflation is, you can call it stickier, you can call it more durable, whatever you want to call it. If when we walked into this year, the rest of the street said, if you measured U.S. CPI as they were saying 2 to 2.5, we were at 3.3, right? Which is that full point ahead. Which is why when you look at, go back to Lisa's 10-year, I know we got to keep coming back to this, which is why our 10-year, sorry, John, didn't you?
Choking on my water, yes. She doesn't own the 10-year bond, but carry on.
Actually,
well, so it's why we have the 10-year at year end this year at 475. Like, we don't think, when we were doing the math, right, about everybody else was in the threes on the 10-year, right, for year-end 25. You can't make that math work, right? So I think rates are higher. I think inflation is more durable, and that inflation premium as the year goes on gets stacked into the yields.
Scott Besson needs to talk to Bramo about Bramo's 10-year yield.
Well,
call me up.
I spoke to an aide last night, and they said no. He watches everything, every indice. They're like, also he looks at the barrels on the market. He wants to know where oil is every day.
I have no doubt about that. But I think coming into this year, just bigger picture, we thought maybe because they were going to run this hot, there would be a risk that the deficit would get away from them, the Treasury yields would run away as well. January, yields started to push up back towards 5%. We've retreated by 40 basis points. When you hear the Treasury Secretary say things like, I'm focused on the 10-year yield, how much comfort do you take from that? Because we talked about this to close out last year. Would they be constrained, regulated by stocks or regulated by bonds? I think a lot of people thought that maybe they might be regulated by the bond market. Do you take any comfort from that?
I do think that's the right focal point, right? Rates matter in this environment because it matters for equity valuations. It will matter ultimately for earnings. It matters for small caps, right? So look, there was a lot of short positions sitting right on the 4.5% line on the 10-year that scrambled to cover, which is why we ended up at 440 yesterday on the back of the Treasury refunding, which was no news, right? And we didn't see, Treasury Secretary Bessent turn around and say, I'm going to start layering out more and heavier auctions in the 10 and 30 year, right? The 3, the 10, and the 30 were all spot on where expectations were and have been for the last 4 months. So this whole idea that they're going to stop issuing as many bills and start issuing more long bonds may be in the future, but it's not in the current, right? And if that happens, then you start increasing supply, right? The risk you run is the auctions get sloppy, John. And we saw that back in October of 2023, where there just wasn't enough demand. Everybody was crowding to the short side of the curve on the demand, and the bid-to-cover ratios on those long auctions were messy.
And then Yellen made some changes, and it looks like those changes might be sticking, at least for now. Darrell, it's good to see you. Darrell Cronk there of Wells Fargo. On Lisa's 10-year bond yield, which is just about unchanged this morning. With an update on stories elsewhere this morning. We should keep going with this.
Oh, really?
Let's get you Bloomberg Brief. Here's your Hara Hacker. Say it, Hara.
Hi, John. We're actually staying on that story. U.S. Treasury Secretary Scott Bessent says in order to lower borrowing costs, the administration's focus is on bringing down 10-year Treasury yields, not the Fed's benchmark rate. In an interview last night, Bessent said Trump is not calling for the Fed to lower rates. Bloomberg's Sonia Meskin will have an interview with Secretary Bessent today at 1 p.m. Eastern. In other news, shares of ARM Holdings are falling 3.9% in the pre-market. The company reporting better than expected third quarter results, but gave a cautious revenue forecast for the full year. That's adding to recent concerns also seen by AMD this week that the booming market for AI hardware is now on shakier ground. And the NFL is going down under. The league will play its first game in Australia in 2026. The Los Angeles Rams will be the designated home team, playing a team to be determined later. Australia is considered a significant global market for the league with a growing fan base of millions. That's your Bloomberg Brief. John?
Yahara, thank you. Shorter flight for the Rams. So I guess that kind of makes sense, right?
You're coming to me for some interesting commentary on this. Lost cause.
I've learned my lesson. Okay. Up next on the programme, bonds. The morning calls. Plus, LinkedIn co-founder Reid Hoffman joins us in just a moment. Looking forward to that. Live from New York City. You're watching Bloomberg TV. Lisa, that's fascinating. You've got to share that with the audience.
No, we really don't. Let's move on. It's too long.
All right.
Ways to manipulate
Big Brother.
kids.
No, it's very interesting. Okay. Doesn't want to share it. Equity futures on the S&P, positive by 0.2%. I might later. Let's get you some morning calls. First up, Wells Fargo lowering its price target on Ford to $8, noting lackluster guidance for the year. Your second call from Evercore, upgrading CarMax to outperform, highlighting a favourable industry backdrop. That stock is positive by 3.5%. And finally, Piper Sandler lowering its price target on Qualcomm to $190, expecting a 10% decline in handset sales this year. Let's stick with tech. The impact of generative AI under scrutiny as some investors question massive capex spending in the space. Reid Hoffman, the co-founder of Manus AI and author of Super Agency, What Could Possibly Go Right with Our AI Future, joins us now. Reid, it's good to see you.
Great to be here.
I said as you walked into the room, that is a book I need to read. What could go right? Because I'm very worried about what things could go wrong. Let's put it that way. You, in the book, approach something really important. That as we make these technological revolutions, these advancements over human history, actually, it benefits human agency. And I'm worried that maybe with AI, it goes in a different direction. Help me out and tell me why it could go right.
Well, the short answer is it gives you superpowers, right? And it gives you superpowers across a large number of things. Everyone should go try ChatGPT, Inflection's Pi, Anthropic's Claude. Give it a try. You can find, what should I make for dinner? How do I get medical advice that's available to me? How might I have a difficult conversation with a colleague? How might I actually do things in parenting that might be different? All of those things are superpowers that we get.
Are you throwing Lisa under the bus?
I am.
Lisa, do you want to share with the audience what you do?
You can manipulate what your kids look at if you send them links to things that then change their algorithms that then give them more news feeds. in their feed. I mean, there are ways that you can kind of play the system a little bit, and I think that that's proper.
Yeah, exactly. And by the way, it helps them learn. It gets them news about the environment around them. I mean, this is one of the things. If you're not actually, in fact, using these AI agents to learn right now, you should. And like, for example, one of the ways that I do when I approach a difficult subject, say, for example, quantum computing, I stick a technical paper in and I say, explain this to me like I'm 12. Superpowers.
Superpowers.
Yes.
Okay, so my next question was going to be, how should we participate in how we shape this intelligence? And Lisa has given us one idea. Could you give us another?
Well, I think part of the key thing is that my very first chapter is about ChatGPT, where humanity enters the chat. You've got hundreds of millions of people who are interacting with it, and the company watches what works and what doesn't work, and then improves it. So by simply going and experimenting and getting which kind of things are the things that help you elevate your agency, then actually, in fact, helps the company know, oh, these things really work. Oh, these things need to be improved.
At the same time, you talk about technical papers, and one thing that AI does really well is work with technical details, not so much the social, not so much when you have to have certain biases that are baked into some of these algorithms. What are the limitations to this in sort of broad-based application at a time where people are saying this could do qualitative jobs and there could potentially be a lot of biases baked in?
So every major group is working intensely on biases. And actually, one of the things that we did with Inflection and PI, personal intelligence, pun intended, was to teach it to be kind and empathetic, to have EQ as important as IQ. And actually, you see that now in Anthropic's Claude and other things as it's kind of spreading. And so you can actually have these kinds of interactions, be trained in them, and this is kind of reinforcement learning by human feedback, to actually be much better than your average human.
The reason why I find this so fascinating is because I think about my children and what careers they potentially could have. And I'm like, no, not programmer, because that's going to be dead. All of these other ones, probably if you can be empathetic, human, those human skills are probably going to be more needed. That's what people are saying. Are you saying those two are going to go out the window? I mean, what does this do to employment?
So first, I actually think programming skill jobs aren't going out the door. I think there's human amplification, but I think it's also human amplification of like EQ as well. So the fact that you have for example, say a medical assistant that can help you with something, or a coach that might be able to talk you something, doesn't mean you don't want a human coach. It's more coaches the better, right? And being able to make it work.
You're talking about AI for the good.
Yes.
But what about AI in the hands of adversaries?
Well, so superpowers for terrorists, superpowers for criminals, superpowers for rogue states. That's one of the things that we need to be careful about how we navigate. Once again, all of the major groups actually have security groups that are working on this to try to make sure, and that's, I think, part of the having so-called red teaming plans and kind of trying to make sure that that's is minimized as much as possible.
But how do you think the U.S. government should be approaching this? The market's freaked out because of DeepSeek and how much potentially the CCP is putting money into their version of AI. But when you're in China and you want to look at things on DeepSeek that are potentially critical to the CCP, it will not show you. So how does the U.S. government go about this?
Well, so I think it's important that the U.S. government kind of continue some of the threads that the previous executive order did, which is, you have red teaming things, that you actually do world leadership about what kind of things are happening. I mean, there's connections in the UK AI Safety Institute and the US one and the French one, and I think these are important to do. But I think that this is one of the things where there will be multiple AIs, and part of the reason why I want AI not to just be artificial intelligence or amplification intelligence, but also American intelligence as part of what we're doing.
What do you make then of the tech industry being very close to this administration? I'm not just talking about your former friend Elon Musk. I was at the White House yesterday and Bill Gates was walking into the West Wing for meetings. Do you think they can help the administration basically get to there faster when it comes to safe AI?
In the short, absolutely. I think it's, if you said of any kind of Western democracy government in the world, most especially, of course, American presidency, American government, should they be connected with the tech industry, talking about how tech's creating the future? What are the things that we can do to make better American industry, better American society, better lives for American citizens? The short answer is absolutely.
What do you make of the backlash against Elon Musk more recently about his involvement with government?
Well, in government, the move fast and break things maybe should be, a little bit more compassionate and judicious.
Is that what you think the approach should be?
I think that the question should be is trying to say, hey, look, there's a reason government doesn't work like companies, even though I think there's efficiency that's really good, and we need to respect those reasons too.
Do you feel that you're going to basically get some sort of repudiation because of where your politics were ahead of this election, and given how Trump has basically cozied up to a lot of individuals in the tech world? I have not seen you yet at Mar-a-Lago at inauguration or walking into the West Wing.
Look, I think the thing that we most want as American citizens is for our government to succeed for our industry, succeed for our citizens. And so that's what I most want. And I think we all do.
You have been an incredible investor. You were an early investor in OpenAI. You invested in LinkedIn. You just so many of the behemoths currently. Do you see a lot of upstarts right now that look like they could become the next big thing in some of this machine learning technology?
So the short answer is yes, although picking them is one of the difficult things about being a venture capitalist, and there's a lot of different options. Back, a few years ago, I was arguing that we were 5 large tech companies heading to 10, but I wouldn't necessarily have predicted that NVIDIA would have so quickly become one of those, into the 7 and then going to 10. And so I think we are in that progress, and I think there are a number of startups that are creating amazing technology, and then the question is product market fit at scale.
What do you think the next technological evolution is going to be that could potentially be a sort of ChatGPT moment or a DeepSeek moment or one of these sort of breakthrough ahas?
One of the things I think we're going to see this year, all of the major AI companies are working on amplifying coding. And one of the things, like, for example, for your kids, other things will be, yes, you have to bring up, will be actually, all of us will have a software engineering assistant, and that will make all of our work a lot better. And that's one of the things I think hasn't yet entered the consciousness. So I think that's one of the things that's coming. And then, of course, with what I'm doing with Manus, I'm hopeful that we will have some really great early results in curing cancer.
And how we can accelerate the scientific process. And yes. I think we're all up with you on that page. I hope you're very successful. Thank you, sir. Really appreciate your time. Thank you. It's good to see you. Reid Hoffman there of Manus AI and a whole lot more. Up next on the programme, some jobless claims data just around the corner. That data drops in about 5 minutes' time. Terry Wiseman's going to join us, and Sonia Meskin from New York City. This is Bloomberg. Equity futures on the S&P 500 positive here by 0.2%, just about unchanged on the Nasdaq. In 20 seconds' time, we get some economic data. Look out for jobless claims. The estimate 213, the previous number 207. We switch up the board and get to Lisa's bond market. The 10-year Treasury yield looks like this. Yields up a single basis point. We should brand it that. 443.22. We can rename the data check part of the screen.
Can you imagine?
Yeah, it would be good. Okay. Jobless claims drop. The numbers look like this. The estimate was 213. The previous week was 207. I'm trying to stretch so the number itself does actually drop. We're still waiting for it. I can give you some numbers elsewhere as we wait. It's a small upside surprise. 219 against an estimate of 213. The previous read was 207. 219, as you all know, on a historical basis is exceptionally low. So still in the low 200s, just a small bounce from the previous week.
And you see a small tick up versus expectations for continuing claims. The revisions, again, very much tame. I would be surprised if the market responded in a massive way to this, because it doesn't indicate that things are really falling off a cliff. And we heard earlier from Jonathan Pingle, not Junior, but Jonathan Pingle the younger, who was saying that this actually might become the more interesting data point at a time of stagnation where the jobs number tends to be from a data generator.
The bond market at the moment, the yield is higher by a single basis point, the 10-year 443. Going into tomorrow, and that random generator, the number that we get on Friday morning, payrolls Friday, it's like the most important number in the world, and it's like the random number generator that spits out something like 200,000. Who knows what we're going to get?
In fairness, that's better than having some conspiracy theory about why they then downgrade the expectations by 800,000 the following year. So it has been a messy number. There are criteria that go in. maybe it's more accurate, as the most accurate forecaster just said, to just view it as a random number generator.
The estimate for the random number generator tomorrow is 170. The previous number was 256. That estimate comes from our survey here at Bloomberg. That's the median, 170. Terry Wizman of Macquarie joins us now for more. Terry, it's good to see you, sir.
Good to see you.
Lots to talk about the economic data, but we've got to start with Lisa's bond market and the comments from the Treasury Secretary, Scott Bessent.
Love this.
This administration focused on the 10-year yield. I asked this question of Darrell Cronk a bit earlier. I'm going to ask it of you. Does that bring you comfort as someone who follows the bond market?
Absolutely. First of all, it's an implicit admission that the short-term yield is not within the purview of the Treasury Department or the administration. That's great because it's effectively an admission that the Fed should be independent, right? They deal with the overnight rate. They deal with Fed funds. And what Scott Bessent is saying, we deal with the long end of the curve. Now, that's natural. It's the Treasury that issues bonds and long-term bonds. So you would see the logic behind the idea that it's the Treasury that should have some purview over the long end. But he also said something different that also gives me comfort. He says he wants to bring the long-term yield down by virtue of lower structural inflation. And that comes through better productivity. And I think that ties in very nicely with some of the policy agenda of the current administration. So it all fits together.
It all fits together and makes some people bullish bonds, and that's what we saw, especially when you add on top of it the Treasury refunding announcement that came out completely unchanged, so it wasn't the terming out of debt. Just how much more bullish did you get on that lovely 10-year note yesterday?
I didn't get that much more bullish because in the final analysis, what is going to drive sentiment for the 10-year are things like the deficit, and this was not so much a statement about the deficit, although there are, anecdotal stories out there about what Doge is doing and what Elon Musk is doing to try to reduce government expenditures. I got a little bit more excited about that part of it that seems to suggest that they're going to be hands-off with regard to the Fed. And if you'll notice what happened this morning, the dollar rallied. And I think to some extent, the reason that the dollar rallied this morning was because people were interpreting this not just as something that has to do with the long-term yield, but also something that has to do with the Fed funds rate and Fed independence.
What have you made of the move that we've seen in the dollar with respect to some of these tariff announcements, given the fact that initially it was the haven play, and then it was sort of unclear, and people walked that back, and then there was questions about the loss of American exceptionalism, worries about the deficit. You could create your story. What do you make of some of the reaction that we've gotten recently?
Well, the dollar has strengthened a lot. So, you can interpret the weakness that we've seen on the back of the tariff announcements as a sell the fact situation. In other words, it's not really fundamentally a weak story for the dollar, but so many people had built up long dollar positions. They may have used the tariff announcements as a reason to take those off, and therefore we had some volatility in the dollar. But like I said, as of this morning, the dollar seems to be strengthening again. The administration seems to be granting more independence to the Fed. That certainly is not part of the problem at this point.
You're talking about tariff bombing, though, when it comes to Europe and China, according to your note. And then you say, where's a tariff bomb shelter? Where are they?
That's it's very, very difficult to find one because, when people get worried in the market and sentiment turns south, correlations go to one, and it's difficult to hide and find any pockets of stability or robustness or strength. I will say, however, that some of the bad news, I think, with regard to Canada is already out, right? You want to go to those places where the news has already come out and try to avoid the ones where the news is about to come out later, right? On the premise that if the news is out, it's reflected in the price and maybe there can't be much more action. So I point to Canada, if only because the worst seems to be over. Now, we may revisit the issue in 30 days, but again, the initial shock is gone, is past us. That might be a good place to hide. The Japanese yen, in terms of the FX market, may be a good place to hide because I think the BOJ is very cognizant of the need to assuage the Trump administration, not to let the yen weaken further. So that might be a place to
Also, Japan has a trade surplus, which Donald Trump likes. He hates trade deficits, i.e. Europe, and he says Europe is going to be next. How are you looking at the euro? Is this parity for this year?
We don't think it's going to get that bad because I think that, again, a lot of the bad news is out and a lot of this is anticipated. But and I do think that ultimately, speaking about the year, as we get closer to the end of the year, there will be compromises on the main issues that divide the U.S. from the EU. Things like energy policy, things like disposition towards China. I think these could be resolved. I think there's enough commonality. But Trump being Trump still wants to use the divisions that have prevailed over the last few years to try to get his way and try to get the compromise to be more in his favor than in the EU's favor. So over the next few weeks, I do believe that we may see more tariff bombs. They'll be directed at the EU. And again, you want to think about, actually at this point, about finding those places to find shelter in.
Directed at the EU and maybe not the UK. Let's talk about the UK. The Bank of England cutting interest rates about 90 minutes ago by 25 basis points. A couple of individuals on the MPC voted for a half-point reduction, including one prominent hawk, which was a big change from the likes of Catherine Mann. Sterling's down to 124, 123.90. What's the Bank of England doing, signalling interest rate cuts, more to come at a time when inflation is still above 2% and will be so for the next several years?
I think they're looking at the direction of inflation as opposed to the level. And if you look at the UK, services inflation, the services component of the CPI, had been very sticky until about 2 or 3 months ago. And even there, where people had expected no stickiness and really no decline, no disinflation, we've seen a precipitous disinflation in service prices in the last month or two in the UK. And I think that's giving them comfort that underlying structural inflation in the UK has come down and that this 2.5% that we're seeing in headline CPI is real. It's not about to evaporate, and we're not about to get inflation again.
No stagflation then? Because downgrading your growth outlook and upgrading your outlook for inflation is not a good thing to do.
It's not a good look, but I don't think that there's really much that the UK can do in the very short term about the growth outlook. Remember, that depends on productivity, it depends on demographics, it depends on innovation. These are not things you can fix overnight, even in a liberal economy like the UK.
There used to be this belief that there was a constraint on central banks like the Bank of England and the ECB on cutting rates in response to weakness because the weakness in their currency would lead to an uptick in inflation. Why is that no longer on the table?
I'm not sure that it's no longer on the table. I do think that they look at the currency, and if the currency were to decline quite a bit, I think it would sound off alarm bells about the prospect for FX pass-through into inflation. I think the issue here is that we haven't seen a precipitous, large, consistent decline in these exchange rates. If it were to drop by 2 or 3% over the course of a day, it would be taken to imply a lack of market confidence or a collapse of market confidence in these currencies, they would react. But these are slow moves. These are trending moves. And I think because of that, there's no sense of panic that you need to address it with interest rates.
There's a bigger point here, and John was alluding to this earlier, that maybe some of these single mandate central banks are becoming more dual mandate central banks, just incognito, right? That they're going to allow a weakening in currency, allow inflation to remain a little bit higher because the emphasis needs to be on growth at a time where they are being left behind. How much do you think that that is a template for other central banks, namely the ECB, in the weeks to come?
Let me first say that that's a dangerous policy to follow. And the reason is that sometimes when you see slow growth, you don't really know if it's the result of poor demand, poor aggregate demand, or a lack of an expansion of the economy's possibilities, i.e., an expansion of the production frontier. And if you're cutting rates, if you're cutting rates in the face of a disinflation that is being caused by weak demand, that's okay. But if you're cutting rates on the back of a declining growth that's being driven by poor supply conditions, you may end up simply creating a lot more inflation. And I think that the central banks need to make a better distinction when they issue projections about GDP. What is the underlying driver here? Because what the underlying driver happens to be should play a big role in how they address the slowdowns with interest rate policy.
Hey, Terry, this was smart. It's good to see you, as always.
My pleasure, John.
Bit of a clinic, as always, on foreign exchange and the bond market as well from Terry Wizman of Macquarie there. If you are just joining us, welcome to the programme. 10 minutes ago, we got some economic data as focused on jobless claims. It came in, small upside surprise, 219. The number we were looking for in our survey, the median estimate was 213. The previous week was a revised 208. In line with what we've heard so far this week, things coming in just a little bit softer, but with the emphasis on a little bit, just a little bit softer on jobless claims, a bit softer on job openings and the jobs data that we saw over the past few days as well. The ISM also just a little bit softer. Taking some heat out of the American economy seems to be the big takeaway so far this week.
And it's welcoming to see, people are welcoming the idea of taking a little bit of heat out of the U.S. economy because it's not coming with it falling off a cliff. I do think it's interesting, this idea that we're seeing stagnation on some levels when it comes to job growth, and this question of when that creates fragility and when that's actually something that just is a feature of a very stable economy that keeps chugging along.
I say some heat's coming out, then we'll get payrolls tomorrow and it'll be like 280.
It's in random number generators.
I've got no idea what the number's going to be. Yeah. The estimate in our survey, the median, just to give you a sneak peek of things, 170. The previous month, of course, 256. Sonia Meskin of UBS dropping by for more. Sonia, good to see you. What are you looking for from tomorrow's number? And to Jonathan Pingle's point of Natixis, why is January so hard to forecast?
You know, January tends to be quite seasonal. There's also weather effects as well. So we have this impact of seasonality, and we've had this historically, I think, for at least a few years, that is amplified in January compared to other months. But in addition here, we're going to have benchmark revisions. So the underlying assumptions of how we're estimating data might change as well from the Census Bureau. So we're looking for 200K, but really, as we've published, this is just an exercise in predicting noise.
An exercise in predicting noise. We should collect these. An exercise in predicting noise and a random number generator. This is fantastic. I am curious about what your takeaway is, just more broadly, from the random number generator or, exercise in noise. The stagnancy of this market, that's not stagnation of this market, the idea that we're not seeing a lot of hiring and we're not seeing a lot of firing. Do you take that as being implicitly a negative, suggesting a brittleness that makes this labor market more susceptible to some sort of shock? That's the way some people have been describing it.
Well, that's possible, yes, and tariffs could be one of those shocks, actually. And we would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are, in fact, sustained, especially Canada and Mexico. But on the other hand, the U.S. is doing considerably better than the rest of the world. So that is a strength for us, of course.
JPMorgan had this survey, and they talked about inflation and tariffs have the biggest impact on markets in 2025. I know we're just joking here, but in all seriousness, does it even matter what the non-farm payroll number is tomorrow?
In terms of the exercise in predicting noise, probably less so. Well, of course, in a sense, we would expect, if, for example, the number comes in considerably lower than what the market expects, I would think the market would react, of course. Now, if the number comes in close, as usual, folks are probably going to look through it more and refocus on tariffs.
Well, okay, so let's talk about tariffs then. You don't think Canada and Mexico get implemented. But we still have China. This is just the opening salvo, Trump said himself, and he says he's going after the European Union next. How do you think about tariffs for the rest of the year?
We would think of it as if they were to get implemented. There are really two ways to think about it, right? Two paths. One is just the threat of tariffs that is causing uncertainty already for businesses. And we've seen this in the ISM manufacturing survey, for example, ISM manufacturing as well, and others regional surveys. And the other one is the actual impact of tariffs if they were to get implemented and they had staying power. And in the latter case, it's a bit easier to estimate, though there's still considerable uncertainty. We would expect a bigger hit to growth than inflation, actually.
Something largely absent from this conversation, and absent, I would say, from the news conference with Chairman Powell in the past week. Why no conversation about the fires in Los Angeles and the disruption we all expected in the economic data? What happened to that story?
Well, that's a terrible tragedy, of course. But unlike the staying power of tariffs, we would expect there to be rebuilding exercise and reversion to trend from a hit like that.
So you're not expecting any disruption in the economic data in the weeks to come?
We are expecting this to show up in part in the NFP, for example, later this week. But we're not expecting this to be in effect for the rest of the year necessarily. That would persist.
Got it. Sonia, it's good to see you, as always. Sonia Meskin there of UBS on the data we get tomorrow. So we've got random number generator and an exercise in predicting noise?
In noise, yes.
OK. Is that the promo for tomorrow?
So stay tuned.
Taking the day off.
Special. Actually, I think it's important because you can take something, as you consistently say, from the way that markets respond to this number generator. And I will say the bigger point is going to be less the random number and much more the way that they revise the numbers from last year. Just how much momentum did we have in the labor market going forward?
We've been mentally revising those numbers down, haven't we?
I mean, by what?
Over the last number of months.
700,000 to 800,000?
Yeah.
70,000 minimum people have been talking about they take right off the top.
Is Sonia setting off alarms? What are you doing over there? What's happening? No? You want to tell us what that was? No? Forget about it. All right.
That's just noise.
OK, just noise. That's the noise. 8:30. OK. Sound effects on this programme now. It's a different programme, wrong show. All right. 2-year yields higher by 2 basis points. The 10-year yield higher by almost a basis point, 4.42. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Ford shares are falling 5.7% in the pre-market. The automaker warned its profit could fall by $2 billion or more this year. Ford blaming the weakness on falling vehicle prices. At the same time, it's working through expensive new model launches. On top of that, CEO Jim Farley told Bloomberg that President Trump's threatened tariffs could cost the industry billions of dollars. Meanwhile, Roblox shares are tanking in the pre-market, down 18% after the online game platform reported daily active users that fell short of analyst estimates. The number came in at 85.3 million. That's about 3 million fewer than analysts were expecting. The company also lowering its bookings estimates for 2025. And 100,000 organic eggs worth about $40,000 were stolen from the back of a distribution trailer in central Pennsylvania. State police are investigating the theft, which comes after bird flu outbreaks cut egg supply, causing a massive rise in prices. That's your Bloomberg Brief. John?
Yahara, thank you. Yahara, thanks for this morning. What do you make of that story?
I think that eggs are the new gold. I think that right now you're having a situation where you might have to pay $8 instead of eggs. You're getting egg beaters in your egg McMuffin, and I think that it's leading to a real security breach at a lot of these egg delivery sites.
I love how they said that they had to be, these organic eggs, so clearly they're available for John. Are you going to the black market potentially to find
the
these?
The black market for organic eggs?
I imagine that's what this is. Where are they putting them?
They're going to sell them on Canal Street.
Maybe.
Alongside the Louis Vuitton handbags.
Can you imagine?
They're going to slip out a dozen of eggs.
Or you can maybe pay a premium for the fake Louis Vuitton and then get the eggs inside.
I still don't understand why they don't clear out Canal Street and all that mess and all those handbags.
Sounds personal.
It's part of the tourist attraction.
It's a tourist attraction.
Yeah, you go to New York.
Such a mess down there. Just clear it out.
Oh, man.
I don't understand it. What I also don't understand about that, just to go on a bit of a tangent here.
Please, carry on.
What I don't understand is that just around the corner in Soho, you've got the legit thing, and they're paying through the nose when it comes to the rent for those buildings. Like, imagine how much that costs to rent those buildings in Soho and have a presence there, and then round the corner on Canal Street, they're selling fake handbags.
You think that they're
just
hold on a
doesn't
second.
make
You
sense
think
to
that
me.
they're cannibalizing on Canal Street from the Soho stores?
I don't think it's good for the brand that there's a lot of fakes going around New York City. Let's put it that way.
Idea of loud fashion.
All right.
Idea. Okay.
Just, let's put it that way. Anyway, up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg Surveillance. The opening bell a little more than 38 minutes away. Equity futures on the S&P 500 positive by 0.2%. On the Nasdaq 100 just about unchanged. With some morning movers going into the cash open, let's cross over to Manus Cranny. Hey Manus.
Jonathan, good morning. Honeywell splitting itself in three: automation, aerospace, materials. Elliott got what they wanted, but on the guidance for the numbers this year, it's a miss on earnings per share, sales and free cash flow. Roll it over. Have a look at Ford. You just heard the story there. $2 billion of profit drop. That's what they're expecting. And Jim Farley warns billions and billions of dollars will be lost if we go for full tariffs. He's asking for a reasonable negotiation. Roll it over. Have a look at Roblox. Here you've got daily active users coming in at 85.3 million. A lot less than the market had expected at 88.39. But hours engaged, 73.5 billion on this. There you go, down 19%. That's a shock sticker.
Manus Cranny, thank you. Let's start getting hammered. Going into the opening bell. Manus, appreciate it. Let's get to some events you need to look for through the rest of today. At 1 p.m. Eastern Time, don't miss this. Bloomberg sitting down with the Treasury Secretary, Scott Bessent. We'll take that on Bloomberg TV and on Bloomberg Radio. Plus, Amazon results coming after the closing bell on Friday, the main event. The payrolls report is just around the corner, and we'll get some Fed speak as well. We'll hear from Bowman and Kugler. Looking ahead to next week, get some McDonald's earnings, Coca-Cola as well. So look out for those two names. And then the big data point next week. Once we get through payrolls, we'll be talking about CPI.
And maybe CPI won't be a random number generator. I want to say that what I'm watching very much are some of the projections by some of these companies, in particular the likes of Coca-Cola and Pepsi, about a strong dollar. And then with respect to Amazon, and I keep harping on this, efficiencies. And the reason why is because they have a lot of spending to justify, and suddenly they can talk about the application in reducing some of the headcount. We're going to hear about that more.
And the markets are looking at all this uncertainty when it comes to policy. So are corporates. We talked about Amazon and e-commerce. Ford yesterday, their guidance, they're not putting into consideration some of these tariffs that might hit their bottom line. It might make their supply chains incredibly more challenging.
What's your question for Secretary Bessent a little bit later this afternoon? What are you thinking about?
What's the level of 10-year Treasury that really is the check on some of these policies? And the other question is, does he still plan to term out some of the debt and longer duration bonds? Why did that not come in yesterday's refunding
That would be
announcement?
mine as well. The complaints that we heard about the average maturity under Treasury Secretary Janet Yellen, the issuance at the front end of the curve, the accusation of activist Treasury issuance that came from the likes of Stephen Moran, who's now part of the administration. Look, it's early days, so I don't want to draw conclusions about the last 24 hours and say that they won't be terming out the debt. I don't know the answer to that, but I would like to know just a little bit more detail. Like you, what would it take to term out that debt? How are you thinking about things? Now you're in power, is this beneficial to you to keep things as they were under Treasury Secretary Janet Yellen?
And part and parcel of that is the danger zone for the 10-year Treasury yield. If you're watching that, when does it become a red flag saying, don't touch that dial?
It's worth repeating, it's only week 3. So it's too early to draw any conclusions about any of these things. It's only week 3.
That's right. It is only week 3, but months before Trump got elected, Scott Bessent was on this program really throwing daggers at Treasury Secretary Yellen. So it felt that he would go in and want to ameliorate this situation that he said is completely unfair and that they were manipulating the bond market. Well, it's a lot harder, right, when you have the office and the seat to do that.
He's only just getting a full team in place, right? Before we figure all this out, we also need to figure out how much additional issuance there might be coming down the line further out once they get this tax package passed.
For now, he can punt by saying, it's only week 3, guys. Stop drawing conclusions. So he probably won't answer that. But these are legitimate questions to raise at a time where this was one of the potential headwinds to Treasuries long term.
So we check out your bond market.
Please, I think that would be
Yields
good.
are up at the front end by 2 basis points on a 2-year. The 2-year right now, 4.20. On a 10-year, we're just about to change that, 4.42. Tomorrow, and it's all about tomorrow, it's about the random number generator. An exercise in predicting noise. The payrolls report is just around the corner. The estimate in our survey here at Bloomberg is 170, the previous number 256. Coming up tomorrow, we'll catch up with Sarah House of Wells Fargo, Priya Misra of JPMorgan, Ellen Zentner of Morgan Stanley, and Jeff Rosenberg of BlackRock. Those 4 and a whole lot more from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.